Until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Energy crisis. The IEA's Fatih Birol warns of even more pain to come.
The world has never witnessed such a major energy crisis. We might not have seen the worst of it yet.
Euro battered, the currency edges closer to parity as economic concerns turbocharge the dollar. Plus, lockdown fears return. COVID cases in Shanghai add to anxiety over China's recovery. Let's check in then on the futures as the story around China certainly weighs on the markets in Asia. You're seeing that relatively pronounced. Those Shanghai cases and concerns that additional restrictions will be put in place. The futures putting lower as well by around 0.7% here in Europe. The losses yesterday stateside around 2% on the Nasdaq, around 1% on the S&P. The FTSE 100 currently down 0.1%. We continue to watch the energy complex as well, and we'll focus in on oil shortly after those comments from the IEA's Fatih Birol on the possibility that worse has yet to come in terms of the energy crisis. Oil down about 13% this month, or at least in the last month. The FTSE 100 now down 0.5%. The CAC count lower by 0.6%, or 40 points. And the Spanish IBEX lower by 30 points, down 0.4%. Let's switch it on then, see how things are playing out across assets. We're looking, of course, at the futures stateside. It's the CPI print out tomorrow in the US in terms of inflation, the guidance there and what that will mean for the trajectory of the Federal Reserve. That's the focus for many investors. The futures pointing lower by 0.6%.
Good morning, ladies and gentlemen. Okay, it's time to place stop for our Bitcoin. And the price I'm looking to sell, 20,130. Okay, guys, we was holding it for a couple of days. So it's time for you to place stop loss for Bitcoin. We made 1.5%. Right now, from position we opened, we have 3% in profit. But we will just, in order to make sure that if the price will move lower, we will not close too soon. I will place 1.5% in our advantage, okay, to 20,130. Well done, guys. I'll speak to you later.
Edges, but of course the longer term story, at least this year in the first half, has been higher energy prices. Total Energy is currently gaining 0.2%. Renault lower by more than 2%. It was a miss in terms of their first half results. They do see the supply of semiconductors and chips improving in the second half. The French car maker currently down 2% in the first few seconds of this Tuesday open. Let's get more then and get over to Bloomberg's MLive managing editor Mark Cudmore. And Mark, you're looking at bunds.
Yeah, absolutely, Tom. Good morning. As you implied, everyone today in Asia was tick-watching the euro-dollar as we get closer and closer to parity. Expected to go today. Really, it's just a big arbitrary round number, but it has still fascinated us for the day. I decided, though, to look at some of the drivers behind this euro weakness. Now, obviously, we know about the energy crisis in Europe, and that's been the main part of the most recent leg. But the other part of this story is the deeply negative real yields in Europe. And the story there is really, really quite dramatic. So this is German two-year yields adjusted for headline inflation, the latest headline inflation print out of the Eurozone. And you can see we're close to 8 percentage points. And that's, in fact, with a jump in bunds today, 2-year bunds. But that you can see that this is over the last 20 years, that chart, and how dramatic the slump over the past year has been. We are close to 0%, like only slightly negative real yields only a year ago. Now we're massively negative real yields. And that is really weighing on the euro. I think we might see that parity soon, and that's why this is pretty exciting.
And you've talked, Mark, of course, very clearly about what you think is the lack of ambition around the calls for euro-dollar at parity. We continue, of course, to watch that currency pair with an eagle eye. Bloomberg MLive Managing Editor Mark Cudmore, thank you. Just a redhead crossing the terminal. EDF shares rising, currently around 7.3%. This on the back of the news that the French government is prepared to pay around 8 billion euros to nationalise this energy giant of France. Of course, it already holds a majority stake, and the plans are there to nationalise this business, of course, as the Eurozone grapples with this energy crisis. EDF currently up around 7% on the back of that news, an 8 billion euro payment in the offer from the French government, according to those reports. Now, the euro is edging closer to parity, as we said, with the dollar due to the energy crisis and recession fears in the region, a level last seen 20 years ago, but also playing into the dollar strength are haven plays and a stronger than expected jobs report. That's as investors look ahead to that US CPI inflation print tomorrow. Joining us now is Vasilis Karamanis, Bloomberg's FX reporter. Vasilis, why is euro parity so in focus for us, and what is the next line if we do indeed cross, as it seems now, almost inevitable?
Yeah, hi, Tom. Well, parity is a big psychological level for the market, and it's been a big options play for traders for the past couple of months. So there's a lot of options interest around parity at the moment, and we've seen the first line of defense holding up during the Asia session, and it's going to be very interesting now Europe has opened whether we get another try at the level. The thing is, the market seems to have the trade right now for parity, and the question is whether we get a big gap below if we breach the level, or if there's too much options interest that can help the euro rebound from that level. Now, analysts focus a lot on commodity prices, and to many it's all about that front-month gas. Right now it's trading around 170 euros per megawatt hour. If it goes up to 200 or to 250 euros, then levels like 97 or 95 cents can be at play, other things being equal.
What is the comfort level of the ECB looking at the euro at this point?
110 probably. We're way below their comfort level, and it's. I have to say I'm surprised that we haven't seen any verbal intervention from ECB officials lately. We've seen some comments back in end May when euro breached 105 to the downside. And we're just a couple of days away from when the silent period kicks in, because the European Central Bank meeting is due July 21st. So they only have a couple of days to come out and help the euro through verbal intervention. But that's just always a short-term thing, because talk won't cut it right now. And during these reverse currency wars, where central banks look for stronger currencies as to offset higher imported inflationary pressures, then I think the ECB is at the point in time where it risks a euro crisis. Not an existential one, but certainly below parity levels aren't such ones that ECB officials would feel comfortable.
Okay, euro-dollar currently down around 0.2%, 1.0024, maybe closing in on a point where the ECB has to at least jawbone this currency high. Bloomberg's Vasilis Karamanis, thank you very much. Right, let's get into some of these other key market drivers then with Alex Brazier, Deputy Head at BlackRock Investment Institute. Alex, fantastic to have you in the studio. Let's start then with the question around FX and how strong dollar, weak euro is informing or at least influencing and overlapping your views on equities.
Well, actually, you've got to think about what's driving that move towards parity. And there's really two things going on that are shaping our portfolio allocations. One is the terms of trade shock for Europe, a net energy importer. And the other is that we expect that terms of trade shock, that energy shock, to weigh on demand in the euro area, much more than in the US. So we expect the ECB to pivot its monetary stance, to cease its rate rises before the Fed does. Now, those things together mean that we are underweight European equities, partly on account of the growth outlook and the real income squeeze.
Do you think the Eurozone can avoid a recession at this point?
I think it's difficult to see that avoidance. We've seen since the start of the year the energy shock weighing quite significantly on growth. It took some time to come through, but now you see it in some of the more forward-looking indicators. We expect Europe to enter a pretty clear recession.
And we're going to be speaking to a European Commissioner focused on the question of energy later in the show, of course, as we weigh up the prospects of further reductions from Russia. What about, Vasilis mentioned the prospects of a debt crisis, maybe different to the one that we saw around 2009, of course, Greece focal to that. Is a debt crisis, can they avoid a debt crisis? Is the fragmentation tool, of which we have some details now, not all the details, going to be enough, do you think, to avoid that scenario?
I think it will be enough. Now, question is, how long does it take to be enough? There may be some volatility along the way. But I would go back to the fact that, as we outlined in our report yesterday, we think the ECB will pivot at some point away from its determination to raise rates this year towards ultimately living with a bit more inflation. And there are two reasons for that. One is, as you say, the fragmentation risk of slamming down demand through raising rates. Even if they have a new tool, they will be limited in their ability to raise rates as far as they think they need to. And secondly, the ECB, like other central banks, faces this brutal trade-off between bringing inflation right back down to target and stabilizing growth. And once the costs of rate rises, particularly in the environment of the energy shock, become clear, we expect the ECB to pause. And as a result, you see that reflected now in the currency. But we expect interest rates at the short end to be somewhat lower than the market's currently pricing.
Central banks having to live with more inflation. So what does that mean then on that point around your allocations to bonds in that scenario?
Yeah, I think we are generally underweight bonds, particularly nominal bonds. And this is an environment where we are overweight linkers and overweight some of the front-end rates in Europe and the UK, which we think don't quite reflect some of the headwinds to growth that those central banks are facing. But it's all a general example of how in this environment, this more volatile environment, we called it back to a more volatile future. In this environment, portfolio allocations have to be more granular, more selective, and perhaps more nimble as well.
Now, Alex, I have to ask you, the last time we had you on, around 17th of June, you said, we are not buying this dip. US stocks are up about 4% since then, European stocks up about 2%. I'm assuming that view has not changed.
No, that's absolutely not changed. I think the market has not fully woken up to the new regime that we're in. The great moderation, this 30-year period of low inflation volatility and low growth volatility seems to be coming to an end. And you can see that reflected in some market pricing. So, for example, equities right now don't really reflect much of a probability of recession. They reflect rises in rates that we've seen since the start of the year. But at the same time, inflation break-evens have come back down again towards the central bank's targets. Those two things are probably inconsistent in this environment where we're facing many production constraints. We've seen a labor supply shock. We've seen a huge rotation in spending. All of those things mean that there's a brutal trade-off. You can't have inflation at target and no recession. So market is yet to, I think, fully reflect the reality of the situation.
Okay, the brutal trade-off for central banks and the markets, equity markets, yet to price that in fully. We're going to get more of your calls, very pleased to say, more of Alex Brazier's calls, Deputy Head at BlackRock Investment Institute after the break. Staying with us. Coming up, tension spreads through Shanghai as residents watch the COVID-19 caseload tick higher. We'll get the latest next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Welcome back to the Open. 15 minutes into your European trading day. You're seeing losses now across the benchmark European equities of 0.6%. Every sector apart from energy in the red. The biggest losses being felt in real estate, autos and technology. Just energy again, holding on to some very slim gains. Future stateside pointing to losses of around 0.7%. Let's get to what's happening in China, because that has been a market factor certainly over the last 2 days. Tensions spreading through Shanghai as residents watch the COVID-19 caseload tick higher. That is fueling fears that they're headed back into lockdown little more than 5 weeks after exiting what was, of course, a very bruising 2-month ordeal for many people there. Let's bring in Bloomberg's Rachel Chang, who's been following COVID really from the outset. Rachel, might we then see lockdowns again in the financial heart of China?
Yeah, that's really what everybody fears right now, because, they're only 6 weeks out from what was a horrible whole city 2-month lockdown. But, we're already seeing a lot of compounds locked down individually as they try to get ahead of this resurgence of infection. And people on the ground, of course, are just extremely tense and angry. A lot of people trying to get out of the city before that happens again. We've also talked to a lot of people who are, basically panic buying, right? 10 kilograms of rice, 30 rolls of toilet roll. They just want to be prepared if that situation happens again. As we know, in the last lockdown, there were people who were not able to get access basic medical care or even have a steady food supply during those 2 months. So it's very much a fresh wound. And I think very much a symbol of how China's COVID-0 strategy is just going to keep bringing back these situations over and over again like Groundhog Day.
Rachel, what are the risk factors here? And I just wonder if this is a test case after the lockdowns we saw in Shanghai, whether or not indeed there has been some adjustment to COVID-0, if they can stomach these higher rates and avoid a citywide lockdown.
Well, from what we understand about the Shanghai situation and how China has adjusted its strategy since, there really is no effort to move away from COVID-0. If anything, there has been an effort to optimize COVID-0 to make sure that every city in China is following the same rule book. And so that allows that to keep going indefinitely. And the lesson that was taken from Shanghai by the rest of the cities in China was very much that they can't lock down too late. At the beginning of the situation in Shanghai, the government really didn't want to do a whole city lockdown. We saw them do half the city first, then the other half. And then, of course, those cases just flared right straight up into the tens of thousands a day. So now what we're seeing in other places is very much that the opposite of that, really early lockdowns. Shenzhen locked down the whole city over a handful of cases. We just had another city today, Wugang, which locked down over 1 case. The idea being is you have to get ahead of it. So I think it wouldn't be out of the question at all for Shanghai to just bring that back again, lock down the whole city, get ahead of the resurgence.
Okay, Bloomberg's Rachel Chang on the latest in terms of the COVID spikes that we're seeing again in Shanghai and the risks of another lockdown for that city. Let's bring back Alex Brazier, then Deputy Head at BlackRock Investment Institute. Alex, let's get your views then on China. It's so difficult to gauge where COVID-0 goes. As Rachel was saying, there's been no sign that at least President Xi Jinping is in any view in terms of doesn't want to move back and walk back from COVID-0. And yet we're seeing M2 money supply has increased. So the credit supply is increasing. We've had reports around infrastructure spending being pulled forward into the second half of this year. And of course, Premier Li Keqiang has made announcements around on the need to support the economy. How do you play what could be an economic rebound on China, with the caveat, of course, that COVID-0 is a key risk?
Yeah, I think the market probably got a bit too excited about what was a restart of activity rather than a kind of classic recovery. We should expect very strong growth numbers as the major cities reopen currently. That's not news. I think the interesting things in China are what's going on underneath that. So looking through the shutdowns and the restarts, how strong is underlying growth momentum? And we see some of that weakening, partly on account of the huge spending shift in the West, going back towards services and away from goods, which will drag pretty significantly on Chinese exports. And the authorities, as you say, trying to push up domestic demand to try and compensate for some of that weakness looking ahead. And so you see credit growth yesterday pretty strong. The net of those, we think, is a little negative. So looking through all the shutdowns and restarts, actually we see growth being weighed on somewhat in China.
Okay, so still a drag on growth in China. When it comes to opportunities in the credit space, I know you think there is a window now to get further exposure to that. It was interesting to hear from JP Morgan's Kalanovic, who's been a bull on equities, saying he wants to see a short position, calling for a short position in credit. You're taking the other side of that bet. What underscores your view, your optimistic view on credit?
Yeah, I think in this sort of volatile environment, it's all about looking for opportunities in mispricing. There's opportunity in this volatility, and one of the opportunities we see is in the relative pricing of credit and equity. As I said earlier, we don't think the equity market is very much priced for recession, whereas credit has much more of a repricing under its belt now. And so on a relative valuation basis, on a relative risk basis, we see credit as more attractive than equity, but you have to see them as two sides of the same coin.
Okay, so it's a relative call on credit. When it comes to UK gilts, overweight on UK gilts, I just wonder if the leadership of the Tory party changes that, given you're getting a lot of sound now, a lot of comments and pledges around cutting taxes, so fiscal support for the government. Does that underscore or at least undermine that view on overweight gilts?
No, not yet. I think the main issue around the gilt market is how far the Bank of England is likely to raise rates before it changes course. Now, unlike some other central banks, it's been very clear that very weak growth, possibly recession, is actually needed to bring inflation back down again. The thing is, the energy shock will do a lot of the bank's work for it in squeezing real incomes and slowing demand. So we expect some more rate rises from the bank, but the market is pricing some much more aggressive rate rises in that we think is overdone.
Okay, Alex, fantastic stuff. Great insights as ever. So Alex Brazier, Deputy Head at BlackRock Investment Institute. Underweight still, at least in the short term, on developed equities, opportunities in credit and UK gilts as well, as we weigh up a BOE that's being slightly more honest, maybe, with investors about the potential economic impacts. Coming up, Twitter tanks. The social media giant loses over $3 billion in market value after Elon Musk walks away from a deal to buy the company. That is next. The details. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. We are 23 minutes into the European trading day this Tuesday. Losses of 0.7% now across the European benchmark. Let's get back to the story around Twitter. Shares tumbling in New York after Elon Musk walked away from his $44 billion deal to buy the company. That has set the scene for a disruptive legal battle. Joining us now is Tim Culpen from Bloomberg Opinion. Tim, just set the record straight for us then. You've been looking into the question of bots. This has been Musk's complaint, really, from just a few weeks after announcing the deal. Is this a real problem? And why and can Twitter ultimately resolve this?
Well, it's my opinion, Tom, my opinion specifically, that this is not the problem that Elon Musk makes it out to be. I have actually spent time looking at the way bots are made on the Twitter platform. They have something called an API through which you make bots. I've made a Twitter bot. I've looked at how it's done. And it's my belief that Twitter can do a pretty good job of estimating how many bots would be on the system. So if you assume that they're being honest about it, and I think they'd be pretty stupid to lie about what they know, then I think they're probably pretty close to the mark in saying that the number is less than 5%. Now, Elon Musk thinks differently. I don't know where he gets those numbers from, if he has certain data that we don't have that proves that he is right and Twitter is wrong. But I think really at the end of the day, even if it's a little bit above 5% or so forth, I don't think it's actually very material. We know what the revenue of Twitter is. We know what the usage of Twitter is. We know the whole P&L. We know their assets. So all of those other things surrounding the company are all well and known. And I haven't heard Musk debate the veracity of that other data. So I think really at the end of the day that he's looking for something to negotiate on, and it's going to go to court now, and it'll be played out in the Court of Chancery in Delaware.
It is going to go to court. That's the direction it's heading. Who is likely to be the biggest loser out of all of this as they arm themselves with some of the US's best lawyers?
Well, it doesn't really look good for Musk based on the way the Delaware Court of Chancery works. It tends to basically force M&As to go through unless they see a really, really, really good reason. I'm not a lawyer, obviously, but it doesn't seem like the various things that lawyers talk about as being a good reason to cancel the deal actually exist. Obviously, Elon Musk and his lawyers disagree. But at the end of the day, I think the real losers will be the Twitter staff, some of whom are leaving. They don't want to work for Elon Musk. Then there's, of course, the upheaval. If Elon Musk doesn't buy the company, then what happens? I think the Twitter platform is functioning fine today, but if they're losing staff and it causes disruption...
Let's move our stop loss to 20,028 for Bitcoin. Okay. So well done, guys. If you decided to trade with me a couple of days ago, you're already in profit. We already 2% in profit. So how much you decided to invest, it's up to you, but you can calculate the money you invested at 2%. This is how much you will get return. And we still didn't close this position. As you can see, it moved lower, and we keep an eye on this security. Okay, I'll speak to you later, guys.
but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question.
Great question.
Great question. Great question. Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are the top stories. Energy crisis. The IEA's Fatih Birol warns of even more pain to come.
The world has never witnessed such a major energy crisis. We might not have seen the worst of it yet.
Euro battered, the currency edges ever closer to parity as economic concerns turbocharge the dollar. Plus, lockdown fears return, COVID cases in Shanghai add to anxiety over China's recovery. All right, let's check in on the markets. And certainly China is a factor and has been a factor over the last 48 hours, weighing on these US and European markets. Of course, today down 0.7% across the benchmark. Stateside yesterday, you saw the Nasdaq ending lower by about 2%. The S&P closing lower by around 1%. The DAX down more than 1%, weighed by what's happening in the auto sector. We'll break out your sectors for you shortly. The FTSE 100 down by 0.5%. Of course, the key data point in the next 24 to 48 hours will be the CPI print out of the US tomorrow, the inflation print, and what that tells us. The surveys are for 8.8%. How that directs, of course, the Federal Reserve's response as increasingly the markets assume that 75 basis points is in the cards for that latest decision in July. Let's switch on and see how things are playing out across these sectors then. As I said, the auto sector is certainly being squeezed. This is, I believe, on a weekly basis. We want a daily chart, really, that shows what's going on. The last time I looked, there were just 2 sectors that were in the green and every other sector in the red. It is a risk-off day again. You're seeing money flowing into sovereign debt, particularly across the US curve. You're seeing yields down, price up across those US bonds from 2s all the way to 30s as well, and some fluctuations in terms of what you're seeing across European debt. We're very close, as we said in the headlines, to that euro parity, of course, amid concerns that the Eurozone is edging ever closer to a recession as we look ahead, of course, to what Russia and Moscow will do as that Nord Stream 1 pipeline closes down. That closure started yesterday, 10 days or so of maintenance. Will Moscow reopen that pipeline? And if they don't, what will the economic consequences be for the Eurozone? We're going to be speaking to a European Commissioner on this very subject just in the next few minutes, so do stay with us for that. But risk off again in the session today, 30 minutes into your trading day. Let's get back to the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. U.S. Commerce Secretary Gina Raimondo says President Biden will announce a decision on easing some China tariffs very soon. In an exclusive interview with Bloomberg Television, she said U.S. lawmakers are playing politics with national security by delaying plans to boost funding for domestic chip makers.
If we're going to do this, what can they do on their side of the equation? So while I can't say for sure certainly that is possible. And by the way, if it doesn't happen immediately, it's something that we will continue to pursue, just in the interest of, you know, as you say, fairness. If we're lifting tariffs, what are they going to do?
Australian Prime Minister Anthony Albanese has promised a new era of climate action and energy innovation. In a speech to the Sydney Energy Forum, Albanese repeated his promise for new legislation, including a target of 43% emission cuts by 2030 and net zero by 2050. Activists and Australian Green Party lawmakers say the targets don't go far enough.
We will lay a new foundation for sustainable growth and prosperity, a foundation that will move us from the era of inaction and delay to one where we create new jobs, new industries and drive down emissions.
The White House says Iran is preparing to provide Russia with hundreds of drone aircraft, with some capable of carrying weapons. U.S. National Security Advisor Jake Sullivan also cites U.S. intelligence, saying Tehran is preparing to train Russian forces as early as this month. Moscow has relied heavily on drones in its invasion of Ukraine, with Kyiv claiming to have downed more than 600 of the aircraft. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Laura, thank you very much indeed. Right, candidates to succeed Boris Johnson as UK Conservative Party leader and, of course, Prime Minister have until 6 p.m. to secure the support of at least 20 MPs and get their name on the ballot, with the pictures so far dominated by pledges on personal and corporate taxes. Let's bring in Bloomberg's UK reporter then, Lizzie Burden, of course, covering all of the fallout from the resignation of Boris Johnson. How do the rule changes, what do they mean in practice? How are they different to the way that Tory MPs and Tory leadership candidates were selected in the past?
Yeah, the Conservatives have accelerated the process of shrinking the pool to just 2 names to get rid of Boris Johnson faster, but also so that the rivalries between candidates don't have time to fester, because, of course, the mudslinging's already begun. So instead of the usual 8 nominations needed to get on the ballot paper, that's risen to 20. Then there'll be a succession of rounds to knock it down to just 2 names. Then those 2 names will be put to the party membership so that a new leader is chosen by September the 5th. But Tom, I should say, while the candidate list is both ethnically and gender diverse at this stage, the party membership is not. It just represents 0.4% of the population. And if it chooses a leader in its image, the Queen could end up with her 13th white male Prime Minister.
Another old white man. Well, we've got MPs then, the candidates going around tapping on each other's shoulders trying to drum up that support. And they're also making pledges, billions of pounds worth of pledges around those tax cuts. Who is promising what and can they actually fund it?
Yeah, tax very much dominating the debate at this stage. On the one hand, you've got Rishi Sunak, the former Chancellor, expected today to reaffirm his commitment not to cut taxes until inflation is under control. A very quiet field there, which could work to his advantage. And then on the other side, most of the other candidates are racing to cut taxes from this post-war high because of all that pandemic spending. So Bloomberg has costed these proposals. It turns out that the former Chancellor and Health Secretary Sajid Javid wants £40 billion of tax cuts compared to just £5 billion for Penny Mordaunt. But really, Tom, it's not just about how they can pay for these tax cuts, whether they can. It's also about the degree to which they'll boost growth. That's the question Labour will be asking today. And also how inflationary they'll be, because it would be pretty self-defeating if they add to the cost of living crisis they're trying to deal with. And that will come down to which taxes they cut. Is it business or is it personal?
OK, scrutinising the viability of these pledges. Lizzie Burden, thank you very much indeed on the latest when it comes to the race to replace Boris Johnson as leader of the Conservative Party and, of course, as Prime Minister. Coming up, IEA Chief Fatih Birol warns of more pain to come in the global energy crisis. We are going to speak to Kadri Simpson, EU Energy Commissioner, next. Stay with us for that important conversation. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open. We are 40 minutes into the European trading day. It is risk off, moves into bonds, moves out of equities. Currently down 0.8% across the European benchmark, the European Stock 600. The futures in the US, the S&P E-mini is looking to losses of 0.8%. NASDAQ futures 0.9%, building on the losses that we saw yesterday on Wall Street. Just one sector here in Europe that's in the green, and that is utilities, just up 0.2%. Technology is the leader when it comes to losses, down around 2%. Right, let's get back to what is happening and the importance of the energy crisis. A global squeeze on energy supplies that's triggered crippling shortages and sent power and fuel prices surging may yet get worse. That is according to the head of the IEA.
The world has never witnessed such a major energy crisis in terms of its depth and its complexity. It is interwoven by many factors, including the geopolitics. And I believe we might not have seen the worst of it yet.
Okay, joining me now is EU Energy Commissioner Kadri Simpson. Commissioner, thank you very much for your time this morning. We heard from France's finance minister over the weekend, Mr. Le Maire, saying that we should now prepare for a full cut-off of Russian gas to European markets as Nord Stream 1 goes down for what are meant to be annual repairs. Is that now the default assumption within the European Commission?
Well, indeed, already the natural gas security of supply situation is serious and it is likely going to get worse. So right now, 12 member states are directly affected by the partial cut-off of Russian gas. In June, flows from Russia were down to 1/3 compared to the June last year. And now after yesterday's maintenance started for Nord Stream 1, the flows are even lower. But we have been preparing since the beginning of this year. So to create a buffer for heating season, because Europe consumes significantly more gas when it's cold to heat our houses. To create this buffer, we introduced an obligation to fill our underground gas storage by at least 80% by 1st of November. And this filling operation is ongoing. So right now it's already higher than 60%. And we strongly suggest that member states should continue this filling. And already in May, we presented Repower EU proposal. Well, that helps us to get rid of this vulnerability that we do have our dependence on Russian gas definitely is a vulnerability. And we introduced several actions. One of those is diversifying our gas supplies. And since the beginning of this year, we have seen record volumes of LNG deliveries to Europe. So LNG deliveries from the United States have almost tripled.
Okay, let's go back to the question. There's a lot to unpack there, Commissioner, and it is a topic, of course, of great importance. And you talk about the need to get up to 80% in terms of storage, gas storage by November. What is your level of confidence that that target will indeed be met?
Well, if there is a full disruption, it is difficult. And that's why we have to prioritize also other work streams. So one of those is fuel switch, where we can use alternative fuels. And we will prioritize, of course, renewables. But for this heating season, other fuels might be useful too. There we will do that. We will switch from gas-fired power plants to renewables. But some member states have also announced that for this winter season, they will postpone the phase out of coal-fired power plants too. And then, if there is a full disruption, we have to also prioritize savings. So savings as preemptive savings already now in the middle of the summer, because if our demand is lower, then it helps member states to continue the filling operations of gas storage. And well, underground gas storage gives us this necessary buffer if there will be disruption and if there will be a cold and long winter, then storage, accompanied with alternative gas flows via pipeline from Norway, Azerbaijan, and Algeria, and LNG deliveries will help us to get through this winter.
So it sounds like there are contingency plans in place at the Commission of being drawn up for rationing of gas. Which industries would be prioritized at this point?
Well, right now we have to understand that preemptive saving, that means that not only industry, but also households can change their behavior. And that means that in the middle of the winter, we might avoid the situation that there will be curtailment of some industrial sectors. We can save by not lowering our indoor temperature so low in the middle of the summer than we used to do last year or year before that. We can also prioritize other kind of activities that help us to save gas. And for that, European Commission already in May, together with International Energy Agency and director of this, Dr. Birol, we introduced a saving plan. Of course, if there will be a trouble in the winter, then households are protected consumers, so they don't have to be afraid that they will not manage to heat their homes.
Okay, Commissioner, the markets are betting on higher prices still in 2024. Is that also the outlook from the European Commission? Can we expect prices to rise even further up until 2024?
Well, European Commission set a joint purchase platform in place that helps us to pool our demand and negotiate with our trusted trading partners. And to do so, we have created also regional groups. 2 regional groups are already at place. So first one was created to support Bulgaria, who was one of the first member states who lost Russian deliveries. And this is our answer. So, of course, if there is a global demand that that is not responded by the production, we are in the situation where high prices will remain for a longer time period. But we will negotiate with our partners, and on top of that, if we manage to cut the demand, if consumption is down, then it should also have an impact to our natural gas prices.
And Commissioner, obviously the gas crisis, the energy crisis in Europe is a significant drag on growth, and we're seeing that permeating, of course, and becoming ever more salient. Is it now inevitable that the Eurozone is going to end up in recession as a result of the shortages that we're seeing?
Well, It's difficult to predict, but we do our utmost to avoid, the severe impact on our GDP and our employment rates. And to achieve that, to achieve a milder impact, we have to propose preemptive measures that can avoid the situation that there will be curtailment needs in the middle of the winter.
Okay, so you're trying to avoid those curtailment needs, of course, as we face up to whether or not Moscow will indeed cut this pipeline off permanently. Is there more that the Commission and the individual members can do to alleviate the price pressures, not just on households, but on industries as well?
Yes, of course. What we see right now is that our market reacts to every news that is coming from Russian side. And I think that it is very important to know that that we managed to solve the situation of Nord Stream 1 compressor stations, so that now when maintenance will be prolonged, this will be a Russian political decision. But well, for us, the regional cooperation, solidarity and unity is a key to come out from this situation. There are member states who are dependent on their neighbors because they are landlocked and they don't have direct access to LNG terminals. But there is a solid network in place, so we are coordinating the supply routes, alternative routes, and how they can use reverse flows. We are also promoting the solidarity agreements so that neighbors can use underground gas storage if they don't have their own. And this is from the security of supply side. On price side, Commission has given advice to member states what they can do to protect their households and businesses. There are different work streams, from taxing, from direct temporary support schemes, and also how to tackle those windfall profits that this current situation of extremely high energy prices are also there across Europe.
Okay, Commissioner Kadri Simpson, EU Energy Commissioner, thank you very much for your time this morning, of course, at a crucial moment for Europe, wrestling with the prospects of further reductions of gas from Russia and how to mitigate those impacts from households all the way up to corporates. Coming up, flirting with euro parity, we dig deeper into what the threshold could mean for the markets as European recession worries mount. And of course, gas and energy playing into that. Plenty more ahead. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 54 minutes into the European trading day. You're seeing losses across the benchmark European equities of 0.6%. So setting up for a second day of losses after a week of modest gains for European equities. Futures in the US, S&P E-minis pointing lower by 0.7%. We continue to watch euro dollar. We'll unpack that story for you shortly. It has yet to cross that parity line, 1.0006. Right, let's take a look at the key things markets are watching out for today, above and beyond, of course, euro parity. At 10 a.m. UK time, it's Europe's largest economy in focus. We'll get the latest results from Germany's ZEW survey expectations. That's followed by Portugal's CPI print at 11 a.m. UK time. Then it's Hungary's central bank rate decision at 1 p.m. UK time. And finally, today, BOE Governor Andrew Bailey discusses the economic landscape at an event run by the official Monetary and Financial Institutions Forum in London. Let's get back to the euro then. The euro is edging closer to parity with the dollar due to the energy crisis and recession fears in the region, a level last seen 20 years ago. Joining us now for more is Vasilis Karamanlis, Bloomberg's FX reporter. Vasilis, welcome back to the show. We've been keeping across this story and you are bringing us the insights. Why is there so much importance around this level, around euro parity? And is there an options barrier at play at this point, as Ven Ram from our MLive team suggests?
First of all, parity is a big psychological level. There is a mystique around big round numbers in the currency market. But price action today is kind of like textbook when it comes to big option barriers at play. We've seen since the Asia session the market trying to head lower and breach the parity level, but there's some defense, and there seems to be some strong defense at the moment. What usually happens is that eventually the option barriers give away because the selling pressure from the market is too much for someone to keep defending it. So for right now, it seems that, yes, there are some people that are defending the level, but the dynamics are so strong in favor of euro downside that the base case scenario remains for parity to be breached.
Yeah, that defense is crumbling, but it is still just about holding on by the thinnest of whiskers. 1.0003 on euro dollar. Vasilis, just very briefly, does the ECB have to intervene?
They have to intervene through actions. I'm surprised they haven't done any verbal intervention. They did it when we breached 105. They haven't done it now, and the silent period kicks in a couple of days. But they do have to act. They do have to hike rates. They do have to show that their anti-crisis tool is really big, and the market shouldn't test it.
Vasilis Karamanlis, thank you as we continue to watch euro dollar. Stay with us. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
The world has never witnessed such a major energy crisis.
We cannot collectively spend our way out of high energy prices.
I would be very, very surprised if we went into a new bull market anytime soon. We've just been through the most speculative period in our financial history.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine this week. Here's what's coming up on today's program. Parity play, raw dollar strength pushes the euro towards 1-to-1 with the greenback amid deepening recession fears. The worst is yet to come. The IEA warns the global energy crisis may not have peaked, with crippling fuel shortages and surging prices set to continue. Plus, Twitter tanks. The social media giant loses over $3 billion in market value after Elon Musk walks away from a deal to buy the company. A messy legal battle looms. It certainly is risk aversion, all filtering through into a euro that is so close to parity. 1.0008 is where we stand on the euro dollar. I'm sure we have the confetti cannons ready to go off once we reach that 1-to-1 level. A lot of factors leading into this. One, you have the energy crisis in Europe. You have Nord Stream going on for maintenance, the fear there that the gas flows will be shut off. At the same time, you have CPI readings coming out tomorrow from the U.S. Will that force the euro even lower as well, with the Fed committed to their jumbo rate hikes? You also have Brent crude. That's off 2%. Fears of China growth, more lockdowns potentially to come with more COVID cases of the Omicron, more highly spreadable variant of it. And Bitcoin also a reflection of the worsening sentiment, down 3.5%. It is under $20,000. Let me show you the map across Europe. Again, it is a negative day today. Today, I'm not wearing red, though, to reflect what we're seeing. I'm kind of close. I'm pink here. We are looking at losses of about 0.5% for the UK, perhaps some of the energy stocks doing better there, but we also have the DAX down 1%. So a lot of the big the high beta, more sensitive, cyclically oriented stocks underperforming this morning. But really, it is all about the euro. We are tick watching today. It's been dipping this morning, slipping closer to parity with the dollar, with the energy crisis and those acute recession fears. Now, we spoke to Kit Jukes from SocGen about the currency last week. Take a listen.
I don't think it is, because I don't know how to handicap the risk of the gas getting turned off. I think if we had a give or take a stop in gas flows of any significant nature over the course of summer, autumn, I think euro dollar will trade down at 1995 would be my first guess. Recession would be pretty much unavoidable.
Well, we're now joined by Callum Pickering, senior economist at Berenberg. Callum, I know we freak out a lot about round numbers, so maybe I won't ask you the importance of euro-dollar parity, but a weaker euro in general, what is the real-world impact for the euro area of that?
Well, optically, it's an issue, and markets at the moment are much more driven by sentiment than they are underlying fundamentals. Europe has a very difficult 6 months ahead. We're shifting from a world in which we've been worried about in terms of trade shock in energy, that is, you can get the energy you need, but you're just going to have to pay more for it, to a genuine supply shock where over this winter, parts of European industry may need to get turned off. Alongside that, you have a host of global issues, and so we're looking for safety in the dollar. That seems to be what's pushing the euro down. On fair value, I don't think we're at parity. We're higher, but we need to get through this next 12 months where it potentially gets quite
so
difficult.
It's not necessarily a fundamentally driven story of why we're seeing the euro move in sort of a non-linear manner right now.
Well, if you take a look at the euro versus sterling, for instance, I mean, that's probably the currency pair where you can start trading off political risk and economic uncertainty. You make the case that there's a lot of uncertainty in the UK, but actually on a fundamentals point of view, you don't get the energy exposure and you don't have the big sell-off of the euro against sterling. You do get the sell-off of sterling against dollar. So I think there's a big dollar move here where we're risk off, we're worried about the next 6 months, US is heading into recession, Europe's probably already there, some other emerging markets are starting to look a little bit shaky. Where do you find safety? You find safety in the dollar.
Right. Are you surprised we haven't seen the ECB make any comments around the euro? I mean, back in May we did when we saw euro around, I think, what was it, 105? We're far below that now. Are you surprised we haven't had any attempts at verbal intervention?
Well, it's difficult. You know, there's like what's the third element of being between a rock and a hard place, right? Now the ECB's got this third issue to deal with. You want to raise interest rates, but you have fragmentation issues. You worry about a weak currency. Okay, maybe you want to sound a little bit more hawkish, but then that amplifies the fragmentation issues. And so fragmentation versus a weak currency, I think the best thing to do is, as long as the market's not completely freaking out, if I could say it that way, you basically just sit there as the ECB, you see how things develop. I think I'd be encouraged that inflation expectations seem to be rolling over in Europe, which suggests that even if inflation hasn't peaked, the market at least thinks that the ECB is serious about bringing it down. And so the fragmentation issue probably is settling a little. If the currency gets very weak and you're worried about imported inflation, maybe you have to do something, but I think it's premature.
Well, BlackRock was talking about this idea of inflation expectations coming down. We've certainly seen it in break-evens in Europe, but their argument is essentially, look, the market has gone too far in pricing some of that inflation out because we are on the cusp of potentially gas getting shut off and inflation shoots much higher after that. Is that fair? Have we gone too far in inflation expectations?
It really depends on how serious central banks are at dealing with this inflation, and this is where the economics of it really starts to matter. We've, in hindsight, realized we've pursued for 18 months a monetary policy which is far too easy. So what we've done is we've accommodated these supply shocks. The price of oil and gas has gone up and other commodities, but we haven't cut back our spending on other areas. So we've had no relative price action so far. That's allowed this inflation to broaden. But you can have a supply shock without this broad-based inflation. If monetary policy is set right, you have to spend less on other things, and then you get the relative price action. If monetary policy is sufficiently tight, and I think the path is sufficiently tight, then if we get further price shocks out of food and energy, we'll be forced to spend less on other things. Then you'll see the margin squeeze, then the inflation will come out. So actually, I think central banks, as long as they persist, you won't get broad-based inflation if we get another supply shock over the winter.
See, this is really interesting to me because one argument I was kind of compelled by, but that I think you're disproving a bit at the moment, is that the Fed, the ECB, they won't be able to stop hiking rates because, sure, they bring demand down, but it'll never be at the level that commodity supply is at. So even if we go into a recession, demand is deep, the Fed, the ECB, they have to keep rates where they are. They can't ease up. Are you essentially saying that, no, this project will be enough to rein in inflation, and so you won't have to have this ultra-tight monetary policy even if we're in a recession?
The balance of demand and supply is not the only thing that determines price setting. Inflation expectations matter, sentiment matters too. So you can see a world actually where you still have, let's call it excess demand, but it's really a lack of supply, with much lower inflation rates, assuming that market participants, economic agents expect central banks to deal with this inflation. If their expectations are sufficiently well anchored, price setting today will be dampened by more than it is now. What we need is for the supply issues to disappear, for sure. That's probably why we get the recession. It's not that central banks will induce a recession because interest rates have got so high. It's actually because we've got too much money chasing too few goods. And all of the gaps you see in the data between spending and output are the thing that really matters now. All the central bank can do is essentially deal with the one problem, inflation, and wait until supply is fixed, which probably means actually we're looking at a recession for the next 12 months. And then next summer, once global supply can adjust, maybe then we see some hope actually that we see in output terms things start to grow again.
One thing that I have to say I thought was really smart in your research that maybe is straightforward, but I just didn't think about it. This idea that you write, we would have already been in a recession in Europe if not for the post-COVID-19 return of travel. But is there an element where we're seeing really high travel prices? I'm struggling to find a flight home that isn't, over £1,000. That will start to dampen, and that also brings about a recession quicker.
Well, so the distribution of spending is key here. A couple of things to keep in mind. We don't have late cycle dynamics. We're really at the start of a business cycle. We don't have the excesses in inventory and in capital investment, in credit. We also have a lot of pent-up demand, a lot of excess savings. And so you're probably gaming for a modest recession with strong demand for services, weak demand for goods. That's if the monetary tightening works. So travel and tourism probably remains strong. People have got cash, they want to go out. Labor markets and employment terms are still strong, so I wouldn't be surprised if people hold their nose and keep spending. That's what's driving prices. There's a fuel component for sure, but actually airlines have got pricing power, and so they're putting their prices up. That means demand is there.
All right, Callum, stay put. We have much more to go over. Callum Pickering, their senior economist at Berenberg, stays with us. Now, coming up, the race to replace Boris Johnson as UK Prime Minister intensifies, the Conservative Party laying out the rules of contest. We're going to have the latest on Westminster political maneuvers next. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Candidates to succeed Boris Johnson as UK Conservative Party leader have until 6 p.m. to secure the support of at least 20 MPs and get their name on the ballot, with the pitches so far dominated by pledges on personal and corporate taxes. Let's bring in Bloomberg's UK reporter Lizzie Burden. Lizzie, so this time around, how are the rules going to be different to select a party leader?
So the Conservatives have accelerated the process to shrink the pool of candidates to just 2 names, firstly because they want to get rid of Boris Johnson faster, but also so that the rivalries between candidates don't have time to fester, because of course the mudslinging has already begun. So what's different this time is instead of 8 nominations to get on the ballot paper, they need 20, as you say. Then there'll be a succession of rounds to whittle it down to 2 names by July 21st. Those 2 names will be put to the party membership for a new leader to be elected by September the 5th. But I should say, the list of candidates might be ethnically and gender diverse at this stage, but the party membership is not. If it elects a leader in its image, the Queen's going to have her 13th white male prime minister.
And in terms of what these candidates are pledging, I mean, we've heard a lot about taxes, things of that nature. What are they promising? And if that's what they're promising, can they actually fund it?
Yeah, so tax very much the fault line at this stage. Rishi Sunak, the former Chancellor, is expected today to reaffirm his pledge not to cut taxes until inflation's under control. Interestingly, 3 former Tory Chancellors are backing that. And even if it's a lonely place to be in, that could work to Sunak's advantage. On the other side, though, most of the other candidates are racing to pledge to cut this post-war high tax burden, and we've costed it. So Sajid Javid, the former Health Secretary and Chancellor, he's promising £40 billion of tax cuts. Penny Mordaunt, by contrast, is offering £5 billion of tax cuts. But really, Danny, it's not just about whether they can fund these cuts, it's also about the degree to which they'll boost growth. That's the point Labour will be making today. And how much is it going to add to inflation? Because it'll be somewhat self-defeating to add to the cost of living crisis that these cuts are trying to deal with, and that comes down to which taxes they cut, whether it's business or personal.
Lizzie, thank you so much. That's our Lizzie Burden on the latest on the UK politics. Callum Pickering, senior economist at Berenberg, is still with us as well. Callum, first let me say I've never felt more short in my life than having you and Lizzie both on set with me. Very separate matter. So Lizzie, they're talking about some of these tax pledges to cut taxes, and of course at a time when the UK is trying to battle inflation. What does that do to the inflationary picture? Is that a mistake of the political orient of making that there?
Well, the essential problem comes down to the fact that there's too much money chasing too few goods. We have a demand and a supply issue in the case of the UK. If you add to demand through tax cuts, that risks leading the inflation into next year, into the year after. That's not to say that there aren't certain deciles, say probably the bottom 10th or the bottom 2/10 deciles, where you can provide some support and really help people out. But when you start to get to the middle income and the higher income groups, tax cuts are just a bad idea because you already have a lot of pent-up demand, a lot of balance sheet strength where actually you can hold your nose and spend for a long time without needing to go into credit or into savings. And so if it's targeted, good. If it's broad-based, that would just be a bad idea.
Okay, and let's take a step back sort of on the general UK economy as well. And Colin, one thing you always do wonderfully is you keep us grounded away from the doom and gloom. When we're looking at a UK and the potential for recession, you have a great research note out this morning. How bad does a recession get? Humble us here in terms of perhaps we've gone too far with the narrative.
Well, it's early cycle, so we don't expect a deep recession, but recessions develop a character of their own. So the recession could be bad. We could see unemployment. Where I'm confident we won't get any issues is on the financial side. So if you look at the balance sheet of UK banks, of UK households, of UK corporates, of the government, actually you have very, very limited fragility risk. That is, if we have an economic shock, losses in one part of the economy are not going to infect the financial system so that you can't lend to healthy parts of the economy. It's not the 2008 scenario that develops here. With that, you see actually no amplifiers during the downturn, and then during the recovery, a lot of balance sheet strength to springboard. So really what you need is supply to go away and inflation to go away, and then you have an economy with a balance sheet which is primed to recovery. It puts a limit on our risk. A recession could be very bad. Financial crisis seems highly unlikely.
Well, what does it mean for this cycle? Because even during COVID, I mean, defaults were never that high. Did we kind of just skip that part of the cycle?
Well, we never got to a stage where the cycle would, by its own sensibility, get there. We had, after the financial crisis, 10 years of chronic pessimism, slow economic growth, and actually quietly in the background, the UK just fixing its balance sheet. We never had that credit cycle. We never had that genuine business cycle, and hence there's no cleansing to come. What we actually would be having now, I think, if it were not for these supply issues, is a good old-fashioned economic boom. People would be taking on too much risk. Businesses would be borrowing, and there would be some malinvestment. But unfortunately, we've been throttled by these external issues.
I got to be honest, I'm a bit distracted by this right next to you, which you see 0.0004. So we're super close to parity. And I can't let you leave also without asking one of the drivers behind this. We get U.S. CPI tomorrow, 8.8% is what's expected. CPI plus UMich, all these other things led the Fed to do their jumbo hike last time around. How important are these figures tomorrow?
In one respect, they're very important because they're going to decide where sentiment goes in the short term, and that's what's driving these numbers. If we don't think the current economy is sustainable, which it's not, then none of the prices on our screens actually make any fundamental sense if they're being driven by the current data. Just underline that twice. The problem is, what's the famous saying? The market can remain irrational longer than you can remain solvent. So if you want a long euro now, well, you better be able to hold your breath for a while.
Ain't that the truth? Yeah, 1.0003. You just barely avoided getting parity with us. As I've been saying this whole show, we're going to have the confetti cannons go off, so you've avoided that. Congrats, Callum. Callum, thank you so much for joining us. Callum Pickering, Pickering, Senior Economist at Berenberg. All right, let's get to the first word news. With that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny. The International Energy Agency is warning that the global squeeze on energy supply could get worse. IEA Executive Director Fatih Birol says the world has never witnessed such a major energy crisis in terms of its depth and complexity. Now, U.S. Commerce Secretary Gina Raimondo says President Joe Biden will announce a decision on easing some China tariffs very soon. In an exclusive interview with Bloomberg TV, she said U.S. lawmakers are playing politics with national security by delaying plans to boost funding for domestic chip makers.
If we're going to do this, what can they do on their side of the equation? So while I can't say for sure, certainly that is possible. And by the way, if it doesn't happen immediately, it's something that we will continue to pursue just in the interest of, as you say, fairness. If we're lifting tariffs, what are they going to do?
Australian Prime Minister Anthony Albanese has promised a new era of climate action and energy innovation. In a speech to the Sydney Energy Forum, Albanese repeated his promise for new legislation, including a target of 43% emission cuts by 2030 and net zero by 2050. Activists and Australian Green Party lawmakers say the targets just don't go far enough.
We will lay a new foundation for sustainable growth and prosperity, a foundation that will move us from the era of inaction and delay to one where we create new jobs, new industries and drive down emissions.
The White House says Iran is preparing to provide Russia with hundreds of drone aircraft, with some capable of carrying weapons. U.S. National Security Advisor Jake Sullivan also cites U.S. intelligence as saying Tehran is preparing to train Russian forces as early as this month. Moscow has relied heavily on drones in its invasion of Ukraine, with Kyiv claiming to have downed more than 600 of the aircraft. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Folks, we are so close to euro parity right now. As we had to break, I need to show you this 1.0002. These are nonlinear moves. We're just talking to Callum Pickering about this idea, saying that perhaps it's not all fundamentals, a lot of sentiment, a lot of risk off baked into the picture here as we get ever so closer to parity. It would be the first time in 20 years. We're already trading at the lowest in 20 years. It is the energy crisis in Europe. It is a strong U.S. dollar, the flee to the haven there. Again, that's what Callum Pickering was said. And at the same time, it is tomorrow's CPI, perhaps a little bit of window dressing ahead of that CPI number. So hold on, we'll bring you parity when we get to it. Just basis points, fractions of basis points away. More on that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It's also the tick-watching edition of Surveillance as we move ever closer to parity on euro dollar. $0.0007 away from the one-to-one level. It's maximum uncertainty right now in Europe as Nord Stream goes under maintenance. Does this mean gas gets shut off? Do the price of gas move ever higher? But as Colin Pickering from Berenberg pointed out, a lot of this has to do with the risk-off trade as we go towards dollars for that haven play. We'll continue the euro conversation next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Parity play, broad dollar strength pushes the euro towards 1-to-1 with the greenback amid deepening recession fears. The worst is yet to come. The IEA warns the global energy crisis may not have peaked, with crippling fuel shortages and surging prices set to continue. Plus, Twitter tanks. The social media giant loses over $3 billion in market value after Elon Musk walks away from a deal to buy the company. A messy legal battle looms. Good morning and welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London, in for Francine Lacqua all week. And it is currently parity watch. We are watching this tick by tick. Yes, we can argue whether parity actually means anything or whether it's just a psychological level, but the direction of travel is clear. The euro just $0.0006 away from being 1-to-1 with the dollar. Of course, as I say that, it's 0.7, but you get the picture. It is declining euro. It is maximum uncertainty with Nord Stream offline for maintenance. Will that be what Russia uses as an excuse to halt the flow of gas? Does that push the inflation problem for Europe even more? Of course, the other side of this is broad risk off in the dollar as a haven. You can see that in stocks falling. You can see that in Bitcoin down 3.4% under $20,000. At the same time, we have China, more cases of Omicron, the more contagious variant popping up in Shanghai, fueling those fears of lockdowns yet again. Brent crude dropping more than 2% at $104 a barrel. So it's about the euro, the battered euro, even closer to reaching parity against the U.S. dollar. As I was saying, it's those energy concerns. It's the risk of recession. All of that weighing on the outlook for the euro area, with risk aversion driving a broad rally in the greenback. Pleased to say we're now joined by Moritz Kramer, chief economist and head of research at LBBW, and former S&P chief sovereign ratings officer. Dr. Kramer, keep our head on straight here. In terms of euro parity, a broadly weaker euro, what does this actually mean? How does this actually matter for Europe, the ECB, the actual story on the ground?
Well, Dan, it's lovely to be back. This is exciting, if only it's a psychological barrier. And of course, it's as much about strength of the dollar than it is about weakness of the euro. So in terms of trade-weighted average exchange rate, the euro is still not at its depth that it had scaled before. But this is a great worry for the ECB for sure, because it makes the inflation problem worse. As a rule of thumb, if you have a 10% depreciation, that adds like 1 percentage point to GDP over a period of 6 to 12 months, mostly because much of the commodity, including oil, is denominated and built in dollars, of course. So that makes the inflation problem worse at a time most inconvenient for the ECB.
Could they even act on that, though, considering they're worried about spreads blowing out? If they wanted to try to combat the weakness in the euro, aren't they pretty limited at this stage?
They are. Their hands are not entirely tied, but the whole timing is unfortunate because the ECB is governing council will next meet when we still don't have clarity how gas deliveries from Nord Stream 1 will, whether or not they will be resumed, because it's just about the same time that the maintenance works will be finished. So they're really flying a little bit sort of by sight. I'm pretty certain the exchange rate will figure much more prominently in the statement and in the press conference afterwards. So the ECB must be worried about that, especially since it's not going to give sort of the economy much of a boost for more competitiveness, because, you know, industry cannot export more because of the supply constraints that you just mentioned.
It's such a good point, because usually we'd say, okay, perhaps a weaker euro is good for exports, is good for the competitive picture. But as you say, it's not at this point.
But just imagine, I mean, Germany had the first trade deficit. I mean, just to have a difficulty to use these two words together in the German context, the first trade deficit since unification boom 30 years ago. So this is a reflection of the problems that we have on the supply chain. So a weaker euro is not going to help very much in that context.
Is it fair that Habeck talks about this idea of this being a Lehman-like moment for Europe if gas does stop flowing?
Well, that's a bit of a hyperbole, I would think, but it is clearly, if gas doesn't resume flowing, and of course it affects different countries differently. Germany, Italy are particularly exposed, but I think we would be looking into a pretty severe recession, which indeed might have sort of the magnitude of the great financial crisis in 2009, simply because this whole supply chain issues just got mega worse through that, because gas is not used for heating only, it's used in industrial processes. So German industry in particular would really sort of be rationed from gas, and then you have the dominoes falling through the economy, through the supply chain. So we would be looking into a pretty unpleasant recessionary environment indeed.
Can Europe avoid a debt crisis at this stage?
Yes, that's actually not the thing I worry most about. I mean, the ECB clearly worries about it a lot. I don't, because I believe that it's not comparable to 2011. We have all these instruments now. We have the ESM, we have outright monetary transactions, which the ECB could use. We have QE, but we also have very, very favorable debt conditions, in the sense that the average interest rate that, for example, Italy pays on its entire public debt is about 2 percentage points. No, they've never paid less interest than they have right now. So it's not how big the debt is, but how affordable it is. So it's bigger than it was, but it's much more affordable. So I'm actually thinking the ECB is barking up the wrong tree here.
Yeah, I mean, to that point, it's a bit of a leading question, because I read your research from the end of last month where you essentially write that the plan is unclear, dangerous, and unnecessary when it comes to keeping those spreads contained. But one thing jumped out at me. You wrote that the hidden threat is that the ECB could provoke the very sovereign debt crisis that the new instrument seeks to prevent. What would that look like?
Well, the ECB has been raising expectations a lot. So they've been basically pressing the panic button when the Italian 10-year bond hit like 4% in yield. That, for a BBB rated entity, is actually not extraordinary. This is sort of where it should be broadly, I think. So this is not the danger zone at all. So now they're raising the expectation of let's call it a Lagarde put on the bond market, but they will probably not come out with very clear rules on how this spread instrument is going to be implemented. So the expectations are very, very high among bond investors.
So what is it? Is it just the market will continue to prod that, continue to test this?
They will test the nerves of the ECB, and I think coming out with this sort of half-baked plan is just inviting another speculative attack.
Is it too late? Is there anything that the ECB can do to have more realistic expectations set by the market?
Well, I think they need to come clear on the next governing council in when is it, 2 weeks' time, to actually make clear what they're thinking, what their trigger points are, what the conditions are. But that's very, very hard to define. The devil is in the detail. I don't think they can really do this. So there needs to be discretion, and as long as there's discretion in the decision-making of the ECB, there will be speculation. When will they jump in? So it's becoming a little bit of a speculative game.
Well, I know you said you're not worried about a debt crisis, but given the concerns of the speculative game, given it seems like we are slipping towards recession if we indeed do get the gas cut off from Russia to the rest of Europe, do those two together equal a debt crisis? Again, if the ECB doesn't rewire expectations.
I'm not sure. I mean, the recession is what I lose some sleep over.
Right, and how bad do you see that recession being?
Well, again, if we meet again in 10 days' time, we'll have a much more informed conversation about that. But so there are two ways into a recession. One is Putin shuts off the gas, and that's the severe one. And the other one is more like of the run-of-the-mill recession, where the monetary authorities, the ECB in this case, have missed the boat on anchoring inflation expectations, and then have to hike interest rates to a degree higher than the markets currently anticipate. That will suppress demand. There will be a relatively mild conventional recession, so that's not so bad. The real risk is really the gas supplies, because that is something that you cannot, through a price mechanism, compensate. You have to ration what is one of the most fundamental inputs into industry.
Right, and it is such a binary outcome as well. Either they continue to flow or it doesn't. Dr. Kramer, thanks so much for joining us. That's Moritz Kramer, Chief Economist and Head of Research at LBBW. Coming up, Twitter tanks. The social media giant loses over $3 billion in market value after Elon Musk walks away from the deal to buy the company. All of that next. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. All right, everyone can hold on to their confetti cannons, their balloon drops for now. We're not yet at euro parity. We're coming off a little bit of some of the weakness that we've seen. We're now at 1.0015. So yes, still very weak. We are still at a 20-year low on this. It is the European gas crisis. It's also haven bids towards the dollar. The concern there of the global economic conditions are making investors flee to the dollar as their haven of choice, especially ahead of tomorrow's CPI reading. So we'll keep an eye on that for you, but not at parity yet. All right, let's get to some of our other top stories today. With the Bloomberg Business Flash is Leanne Gerrans. Hi, Leanne.
Hi, Danny. EDF shares have jumped on a report the government will pay more than 8 billion euros to nationalise the company. In the midst of Europe's energy crisis, France is planning to take the debt-laden utility back into full state ownership. It is reported the cost of buying the 16% of shares the government does not own, plus outstanding convertible bonds, could be as high as 10 billion euros. Now, Bill Ackman has told investors in the largest ever blank check company that he is returning their $4 billion after failing to find a merger deal. The billionaire investor says Pershing Square Tontine Holdings' efforts to find a target company were thwarted in part by the unexpected recovery of global markets during the pandemic. He says that made conventional IPOs a strong competitor for businesses seeking to go public. And Gap shares fell in late trading after the retailer fired its CEO over a series of operational challenges. Sonia Singhal is to go as increasing costs or deepening discounts threaten to wipe out this quarter's operating profit at the U.S. clothes company. Chairman Bob Martin is to take over immediately as the interim CEO. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Leanne Gerrans here in London. Now to Twitter, where shares tumbled in New York after Elon Musk walked away from his $44 billion deal to buy the company. And all of that setting the scene for a disruptive legal battle. Joining us now is Tim Colpan from Bloomberg Opinion. Tim, a really great piece you have out on the terminal where you've looked into the bots on Twitter. I'm aware you've even made your own bot, which you're going to have to teach me how to do someday. Tell me, what did you find? Is the bot problem actually that bad?
It's my opinion that the bot problem is not as bad as Elon Musk says it is. Maybe he's got access to data that I don't have access to. But having had a look at the way bots are made on Twitter, it's pretty open, it's pretty transparent. I do believe that Twitter has a very good ability to assess approximately how many bots they'd have on their system. If you assume that they're being honest about it, and I assume they are, I think they'd be pretty stupid to lie, then I think Musk doesn't really have a leg to stand on, that's my opinion, when it comes to complaining about whether or not Twitter is honest about the amount of bots, or that there is a lot more bots than he says there is. So I think it's really a negotiating tactic or an excuse for him to try and get out of the deal.
Well, this is the thing, Tim. I mean, does the level of bots actually matter to an extent? For example, let's say it's 7% instead of 5%, which Elon Musk claims. Is that actually enough in sort of the contours of this deal to get him out of it?
You know what, I think that's exactly the question people should be asking. We're talking about, is it 5%, is it 3%, is it 7%? I actually don't think it matters that much, because we know what the revenue is, we know what the cost structure is, we know what the profits are, we know the balance sheet, we know the cash flow, so we've got all the major financial statements are out there. We can assume that they're correct and there's nothing fiddled or incorrect about those. So does it matter that it's 7% versus 4% versus 15%? I actually don't think so. I think at the end of the day, we just need to know what the revenue is, what the cost structure is, what the profit is, cash flow and all the other things. And all that's available for Musk to be able to have a look at, or anyone who wants to buy Twitter to have a look at. And they can do their own due diligence or do their own assessment. Now, if there is a reason why a higher or lower level of bots matters to the bottom line, I would love to see that case.
Tim, who would be the biggest loser out of all of this? Maybe that's a very simplistic black and white way to look at it, but I mean, who would be left holding the bag in this deal?
Well, I think Twitter as a company, Twitter as a brand, we haven't really seen an impact on the Twitter product in the last, 6 months that all this has been going on. But, when the company and the product developers and the marketers and everybody involved is kind of in a holding pattern, not really being able to make decisions because they don't know who the new boss is going to be, that does impact. And of course, it impacts on morale. Bloomberg News has reported that people have left the company because they're not looking forward to the idea of working for Elon Musk. So if they want to hire really good people, that's also an overhang. So I think the company is going to have struggles to develop new products and go forward and be a better company while they've got this shadow hanging over them. So whichever way it plays out, I think Twitter as a company, the personnel, the staff, and the product are going to suffer in the long term if it drags out too long.
All right, Tim, thanks so much. Tim Colpan from Bloomberg Opinion. Check out his piece, NIBBOGO, on your terminal is where you can head. Now, for our American viewers, it might be the time to go visit Europe. We're looking at a euro dollar, which continues to slip towards parity, just fractions of a basis point of cents away from parity, 0.007, I think I might have missed a zero there, away from parity with the dollar. It's really the energy crisis weighing on the commodity. It's also at the same time, the currency rather, it's also at the same time a haven bid towards the dollar. Most currencies in the G10 space down versus the dollar today. Sterling, for example, is off 0.5%. Callum Pickering and Moritz Kramer both saying, look, it is all about this risk environment we live in. Folks want to own the dollar in such an environment. It's what's replaced bonds, for example, in portfolios for a haven place. So that also driving the euro lower, just hours, 24 hours, more than that away from tomorrow's CPI number. So that could also drive the euro even lower. Well, coming up, we'll return to the story of the worst of the global energy crisis. It may be ahead of us. That's the warning from the head of the International Energy Agency. More on that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. If you've been following along, it's also the tick-watching edition of euro versus the dollar. We are sliding closer to parity, now just fraction of cents away from it. 0.0012 is how far we are away for 1-to-1. Euro options traders are also pricing in another 5% slide versus the dollar. So yes, that round number has a psychological level to it, but it could sink even further if you believe those options pricing. A lot of this having to do with the energy crisis. We're also listening to German Minister Robert Habeck speaking after meeting with the Austrian partner, if I can find my words, saying that Germany is prepared for all gas supply scenarios. Or recall a couple weeks ago, he called it a Lehman-like moment if the taps get turned off. Well, that global squeeze on energy supply, it's triggered crippling shortages and sent power and fuel prices surging, and it may get worse. That according to the head of the International Energy Agency.
I believe we might not have seen the worst of it yet. This is affecting the entire world.
We're joined now by Bloomberg's executive editor for energy and commodities, Will Kennedy. So, Will, we're looking at nat gas in Europe moving higher today, but we might have to put that aside and separate from what's happening in the oil patch at the moment. It's declining today. You have fears of recession. How would you sort of characterize the state of the market at this moment?
Yes, I mean, oil's under pressure, I think, for two reasons. One, fears, as you say, among traders that the economy is about to slow down markedly. And secondly, a strong dollar tends to be very bad for the oil price. And so as the dollar rises, that puts downward pressure. I'd add a third reason, actually, which is there's still a lot of uncertainty about the recovery from COVID in the US, in China.
Right.
People had expected demand to come back there in the second half of the year, but there are some concerns that the virus is spreading again, and that may not be happening. So you put those three things together, and that's why you've got an oil price under pressure. But it's worth saying, in the real world, and in some of the measures that traders use to gauge strength, i.e. the price of oil now versus the price of oil in a few months' time, the market remains quite strong. So it's not a totally clear picture, but the futures price is being put under pressure for those reasons.
Right, I mean, that's when you see analysts coming out saying, look, this market is still very, very tight. Saying that oil is going to fall further doesn't make sense at this level.
No, unless the slowdown is going to be much worse than people think.
Sure.
That's the concern. But yes, I think when you look into the real world, the physical oil market, what people are doing, what consumers are doing, the supply of oil into the world, then it's not a clear-cut picture. There are still reasons to be fairly bullish about the price.
There's also the political element of it. We have President Joe Biden visiting the Middle East. I think starting today, he'll be there. The U.S. administration had said that they're optimistic that there could be more barrels put online from OPEC Plus, if all goes well in this meeting, essentially. Is that overly optimistic?
It's a very important question for the market. Biden will want some sort of pledge for more oil. He may not get a precise deal or numbers, but clearly they think that they're going to need more Middle East oil. And remember that they're currently putting 1 million barrels a day of SPR oil from their strategic reserves into the market, which is due to stop in the autumn. So if they are going to stop that, they'll need more oil from elsewhere. The question is, how much can they produce and for how long? No one really knows. The Saudis say they have the wherewithal to go higher. But we did have this hot mic situation at the G7 where Macron was caught telling Biden that the Saudis and UAE didn't really have much oil. But there's an important issue for the Americans here. Jake Sullivan went out of his way to say they think there is more oil. But the question both for the Saudis and Washington is, when do you want to use that oil? Do we want to get to a place right now where we're pumping every barrel? Because what happens then if there's a bad hurricane? What happens then if there's another geopolitical crisis? The world would be running with no reserve, and that's a dangerous, volatile place for the global oil market to be.
This I find fascinating about the SPR release as well, because shouldn't the market just be pricing in a refill of that at some point anyway? Because it's the strategic reserves. It needs to be there for crises.
Absolutely, and it's going to end up half emptied, and the remaining oil is not easy necessarily to refine. And yes, at some point in the future, they're going to have to buy that oil back. And the way you look at the dynamics of the market, and it's not easy to see when that's going to be straightforward to do. So I think It's clearly helped the market this summer. Prices would be much higher without it, but it has raised a series of difficult questions for the future for the U.S. administration.
Questions which we will also look to you to help answer. Will, thanks so much. Will Kennedy from our Energy and Commodities team. Now, 5 minutes to go until the close of the hour. Nothing is closing, but we still are looking at a euro slipping. Now, some of the worst of it has eased a bit. We were about 4 decimals away from euro parity. We're now at 1.0012 on the euro dollar. A lot of this is that energy story, which Will was just talking about, especially in Europe. It's also a haven bid into the dollar. Bloomberg Dollar Index, that is higher by 0.3%. Euro Watch continues. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The big market call is much more volatility coming forward.
I'm of the view that equities are the best house in the financial asset neighborhood.
We are heading for some kind of a financial accident.
This is a currency and bond-driven market right now.
So far, the dollar has been a good place to kind of hide.
What we're seeing globally is essentially a huge hoarding of dollars from investors.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kayleigh Lyons.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York, Anna Edwards out of London. Our top stories today: the euro slips ever closer to parity with the U.S. dollar, touching the lowest level since 2002. Risk aversion is prompting a broad rally in the greenback. President Biden flies to the Middle East to talk to OPEC. The U.S. believes that the Saudis can pump more oil if the president's lobbying efforts are successful. Still, the IEA says this is the worst energy crisis of all time, and it could get worse. Plus, J.P. Morgan hedges its risk-on wager. Marko Kolanovic is advising investors to cut holdings in corporate debt. Meanwhile, BlackRock has warned against buying the dip. It sees no quick recovery in sight for stocks or bonds. So there's a lot of concern out there after the sell-off that we saw yesterday in risk assets. Kaylee, what do you see in terms of prep for the market today?
Well, when you look at the picture in Asia, that sell-off in risk assets did continue, with equities down really across the board. China, Hong Kong, Japan, you name it, stocks were lower. As a result, the MSCI Asia Pacific Index was down about 1.3%. Now, of course, in large part, that has to do with concerns about the global economy, the idea that things may be slowing down. But in China specifically, there was also concern about a growing fresh outbreak of COVID and possible restrictions that could result from that. And you're seeing that weighing on the commodities complex, given fears around what that may mean for the demand picture. And that is definitely true of iron ore, which fell 5% overnight to the lowest level going all the way back to December, 7 months, around 105, just under that dollars per ton. As you're seeing selling in risk assets like that, though, you are seeing that bid for haven in the government bond market. That includes Australia, where the 10-year yield overnight came in by about 9 basis points. And then I would point out that the only currency stronger against the dollar in Asia and in G10 is the Japanese yen, though it's coming off the weakest level since 1998, right now trading at 137.18 to the dollar. But of course, Anna, broadly, it is a story of dollar strength today.
Yeah, a lot of dollar strength. Do we factor in some more euro weakness? We've just got some data coming through from the German economy. This is expectations around the German economy from financial professionals, and that expectations number coming in weaker than anticipated. The survey was for minus 40.5. We got minus 53.8. Would that be enough to send the euro into negative territory, below 1 against the US dollar? That's been the key question all morning. Are we nearly there yet? Have we got to parity yet? Traders on both sides of through the Asia session and into the Europe session have been watching tick by tick as the euro moves, and we had seen some weakening, some testing of that parity level through the Asian session, but so far has not managed to breach. And even as we got that disappointing data then out for the German economy, we still don't quite dip below $1. So that's the euro story. We continue to watch that, and it's almost dangerous to take my eyes off the screen because it might just move below it as I do. But let's get to the rest of what's happening here in Europe, and to what Matt was saying about the negativity of yesterday on Wall Street. We had some selling to do here in Europe to continue with that negative vibe of yesterday. So reflecting that weakness in the NASDAQ late in the day, perhaps, we saw weakness across European stocks and most sectors here in Europe in negative territory. So it's pretty broad-based across the European sell-off today. In terms of other assets in focus, we continue to watch what's going on with gas prices here in Europe. That is going to be a key driver, remains so. One of the key reasons we see the euro under so much pressure is the pressures that natural gas story is applying to the Eurozone economy. The price is increasing today, reduced flows out of Norway at a time when we don't really need to see that. In keeping with the energy theme, EDF, a French energy business, this is being nationalized by the French government. The stock is up on reports that the government will pay more than 8 billion euros in that nationalization process. And just to make the point that whilst the euro seems to be defending that one level against the US dollar, the pound is succumbing to the downside. We see continued pressure on the pound to move lower as that strong dollar theme continues to play out, Matt, and the pound down 0.5% this morning.
Yeah, we'll continue to watch the strong dollar effects on the market, Anna. Right now, we continue to see risk-off sentiment in the markets. S&P futures down just about 0.6%. Worries about recession. Of course, tomorrow we get the CPI number, which should be interesting to say the least, and we kick off earnings season this week with the banks. So we're really watching to see if margin compression comes and if we see estimates lowered, especially in the outlooks in earnings season. The U.S. 10-year yield holding firmly below 3 right now at 2.9023. So investors are buying that debt, possibly seeking the perceived safety of treasuries. And NYMEX crude is coming down on those recession fears as well. So down 240 right now to 101.68 a barrel. Of course, as we said at the top, President Biden, and we're going to talk more about this throughout the program, is flying to the Middle East tonight, or scheduled at least to fly to the Middle East tonight to make his case for more oil production. Bitcoin right now down 3.2%. Of course, it's heavily correlated to risk assets, and as we got the drop that we saw yesterday, and again, futures today down, it makes sense that Bitcoin would be a loser below 20,000 at $19,755. Kaylee, you've got that crypto show at 1 p.m. today.
I do indeed. Really looking forward to that this afternoon. And of course, all day today, we will continue to be on parity watch. Right now, the euro trading at 1.0002 to the U.S. dollar. So we'll keep on top of that for you throughout the day. Now, as for what else is ahead today, Amazon kicks off its 2-day Prime Day. A lot of people going to be online shopping over the next 48 hours or so. Plus, the OPEC monthly oil report is released around 7 a.m. New York time. President Joe Biden will be meeting with Mexico's president at the White House. Plus, we'll hear from the Bank of England Governor Andrew Bailey. He'll be discussing the economic landscape at an event in London. And we'll also hear from the Bank of France Governor Francois Villeroy, speaking at the Europlace International Financial Forum in Paris, Matt.
All right, we'll be watching all that very closely. Europe's common currency, though, is really taking the spotlight today. As you just mentioned, edging down ever closer to parity with the U.S. dollar. We're all glued to our screens here. That's as energy concerns and a risk of recession weigh on the outlook for the euro area. Risk aversion fuels a broad rally in the dollar. Investors are selling off most other currencies against it. Bloomberg's Danny Berger is on parity watch for us as well. So, Danny, it's really interesting, this gas connection to a currency. Yes. It's not something you would instantly think of.
No, it's certainly not, but it just presents the economic problem for Europe. Nord Stream is down for maintenance. There are concerns that will be what Russia uses as an excuse to stop the flow of gas through the rest of Europe. That would obviously have major consequences for the economy, for inflation, hence what we're seeing in the euro versus the dollar. I'm kind of bracing myself. We're just fractions of cents away here, 0.003 or 2. It keeps flicking back and forth in terms of dollars away from that parity level. I feel like I'm bracing for like confetti cannons or something to drop from the sky once we get there. But look, it's not just the gas picture, Matt. It's also what's happening in the U.S. We, of course, have CPI tomorrow. 8.8% is the expectation. The ECB is a lot more limited in the amount they're able to hike. So, of course, the weak euro is a problem when it comes to inflationary the picture there, but they can't really do that much. So you get that interest rate differential. And at the same time, the dollar has been a haven bid throughout all of this, with bonds up and down, the worst year for them on record. The dollar really has been the consistent thing that's worked in this environment. So that, too, is weighing on that weak euro.
Okay, so that's the euro story. That's the link with the gas story. We continue to watch that. Yes, still there, 1.0003, Danny. We've also seen some really interesting, Matt was talking about the risk-off tone we've seen on Wall Street yesterday and then into Europe as well today and through the Asia session. And we're keeping an eye on what the sort of famous names of Wall Street are saying about what stocks are going to do next. What's JP Morgan's Kalanovich saying?
Well, he's always been a bull. I mean, is consistently saying buy the dip, buy this market. But we've started to see a softening in that bullish tone. I won't say it's completely done with, but he wrote in his latest research along with the team at JP Morgan saying market pricing of recession risk intensified over the past month. However, this risk is priced unevenly across asset classes, with much higher risk priced into equities than bonds. So his recommendation is to ease up on your exposure of credit, of bonds, because that is where perhaps we haven't seen a total pricing of recession. But equities, he says, is completely pricing in that recession. Now, I should say there's not a lot of agreement on this. BlackRock, for example, they put out research saying don't buy the dip. In fact, they think you should be buying credit and selling equities, so the complete opposite of him. We also have warnings about earnings with a stronger dollar. Citi saying that they think earnings will be strong, actually. So, Kaylee, I think one of the common themes here is a lack of common theme. There's just so much disagreement with the unknowingness of this current macro environment.
A great way to put it, Danny. Bloomberg's Danny Berger, thank Thank you so much. Now, turning now to commodities, the global squeeze on energy supply that has triggered crippling shortages and sent power and fuel prices surging may get worse. That's the warning from the head of the International Energy Agency. Fatih Birol spoke earlier today.
The world has never witnessed such a major energy crisis. We might not have seen the worst of it yet.
Stephen Stepsinski, Bloomberg energy reporter, joins us now for more. So, Stephen, that's not incredibly encouraging. What is the thesis from the IEA here?
You know, we've never seen a situation where so many energy products are in such a large crunch. I think, you know, when we talk about energy crisis, we talk about the 1970s oil shock. That was oil. Now we're facing a pretty tough oil situation in the market, especially as Europe is trying to get rid of imports of that fuel and Russia potentially curbing output, which would have major implications for the market. On top of that, we've got the natural gas crisis, which was highlighted. Russia might not increase flows from Nord Stream 1 when it finishes maintenance later this month. That could cause a huge problem for this winter for Europe as they try to refill their inventories. And then you look at coal. Coal is also at a record high prices in Europe and both in Asia. Across the board, energy is expensive, and never before, according to Birol, has the market faced so many upside risks.
Yeah, absolutely. So upside risks there. What are we seeing action being taken by the US Treasury and in conjunction with G7 leaders? What's the latest on all this talk about whether they're going to be able to cap the price of Russian oil? Treasury officials clearly see that as key to avoiding another cost shock.
Right. The U.S. Treasury wants to create some sort of cap system. They have some sort of broad agreement with Europe. Now they're going to talk to Japan, to India, to try to do that as well. And the way that this would work is, okay, we're going to cap the price of Russian oil that we purchase at. So instead of Brent at $100, we would buy it at a discount. That would allow the Russian fuel to continue to be fed into the market, providing the stability that it needs. At the same time, you wouldn't be giving quite as much money to Moscow, but it's simpler, you know, it's easier said than done. It is not a simple system. It is complicated. Everyone needs to get on board, and India and China might just not.
Right, and the concern, of course, is that Russia strikes back by just pulling millions of barrels of oil a day off of the market. Stephen, thanks so much for joining us. Bloomberg Stephen Stepchinski there talking to us about the energy crisis. More on that, President Biden is set to leave for his first trip to the Middle East since taking office. He aims to secure a pledge for more oil from Gulf allies. Joe Matthew, Bloomberg Washington correspondent, joins us now from D.C. for more on what to expect. So talk us through Biden's trip and how he plans to do this with Mohammed bin Salman.
Well, there are a lot of questions, Matt, about what exactly the president will be able to secure on this trip as the White House continues to remind us that this is about more than just oil, that this is, in fact, a security-oriented trip that could result in more energy being unleashed here. Look, the fact of the matter is, as far as the OPEC members are concerned, Saudi Arabia and the UAE are the only two countries that have spare capacity. According to their official data, 3 million barrels a day, about 3% of global output. That's according to them, but there are skeptics, including the CEO of Shell, who recently warned of a turbulent period because OPEC, he says, doesn't have necessarily the spare capacity, particularly Saudi Arabia, that some people seem to think. You've also got the matter of refining bottlenecks here, something we've talked about a lot, Matt, with 95% capacity already spoken for in the U.S. So even if the president managed to get, you know, a significant commitment here, there's only so much it could do potentially to lower gasoline prices.
Meanwhile, on the more domestic front, Joe, we are bracing ourselves for more Capitol Hill hearings today, January 6th panel hearings in particular. What kind of fireworks could we see today?
Well, today they're going to focus on, it starts 1 o'clock Washington time, they're going to focus on connecting the dots between the White House, and we're not sure exactly how they plan to do this, and some of the groups, the militant groups that were there that day, like the Proud Boys, the Oath Keepers, whether this was directly from the White House or some sort of back channel. They talk about convergence, the folks on this panel, the lawmakers, and it's their aim to prove that today. there was a prime time hearing set for Thursday night. It was just delayed, and we're not exactly sure why. They've been making some changes with their witnesses, and of course, one that we now know could be Steve Bannon. The president's former advisor has gotten permission from Donald Trump to testify. He says he's lifting his executive privilege in this case to let Steve Bannon testify. And Steve Bannon would like to do this, by the way. He would like to go there to defend Donald Trump, who believes that there's no one on that panel to stand up for him.
All right, Bloomberg's Joe Matthew, thank you so much. And of course, you can listen to Joe's coverage of those January 6th hearings later today, and also hear him every weekday on his radio program, Sound On, at 5 p.m. Eastern on Bloomberg Radio. Now, in other D.C. news, another story that caught our eye, Elon Musk says Donald Trump should, quote, sail into the sunset and forget about running for president in 2024. In a series of tweets, Musk claimed that Florida Governor Ron DeSantis would easily defeat President Biden. He also told his 100 million followers that there was too much drama when the former president was in office. And speaking of Elon Musk, let's take a look at some stocks moving in pre-market trading here in the U.S. because no surprise, Twitter is on the move, as is Tesla, both related to him, as Elon Musk said he wants to abandon that $44 billion deal for Twitter. Investors are waiting for all that legal drama to play out. We saw Twitter down 11% yesterday. It's off by another 0.7% or so in early hours this morning, but trading around $32.43 a share. That is $22 below Elon Musk's offer price for the company. Meanwhile, Tesla is down about 1.4%. And another EV maker to keep an eye on is Rivian. Bloomberg scoop late in the trading day yesterday about job cuts at that EV maker. The stock was down about 6% yesterday. Partially on that news, it's down another 2% in early hours this morning. And one more story to keep an eye on is Gap. The company announcing yesterday it has fired its CEO, Sonia Singhal. Its chairman, Bob Martin, will be stepping in on an interim basis. And the company also warning about the fact that higher costs and more discounting that they have to do is going to basically erase their profit for the current quarter. So that stock is down more than 6% before the bell, Anna.
Kaylee, we're still watching. We're still on parity watch, still waiting to see if the euro hits parity against the US dollar. We are ever so close. We are just 0.02 of a US cent away from that happening. Such are the small margins, and we're watching this tick by tick. You've got the latest price in white there. You've got the bid and the ask spread around it, and we're continuing to watch to see if we get to parity. Our colleague Ven Ram on the Markets Live blog writing that there are barrier options standing in the way. Certainly somebody defending that level pretty hard. Coming up on this program, Antoine Bouvet, senior rate strategist at ING. FX, a key part of that race story at the moment. We'll talk to him about this. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Welcome back to Bloomberg Surveillance Early Edition. We are on parity watch. The euro is falling so close to the dollar that we can't take our eyes off the screen. I'm looking at a GIPT chart. For those of you listening on radio, you can do this with any security and watch tick by tick as it trades. Now up to 1.0003. It's been trading around 1.0001. Let's bring in Simon White right now from the MLive team to ask, Simon, who's defending parity here and why?
Well, and that I'm not 100% sure. I think it's probably option related, but it's it's a matter of when, not if, the parity gets broken. It's been on the cards for a long time.
Yeah, our colleague Ben Ram talking about barrier options lying in the way, which was not a term I was particularly familiar with. So that's something to for me to think about this morning. It just moved up a little and now seems to be coming down again. I suppose one of the questions also we asked this morning is how long it stays, just below $1, or whether it bounces back. And I've read different things actually on that subject.
Well, I think whenever you get repressed volatility, which is what we're seeing here, you tend to get a lot of follow through. So, to paraphrase Boris Johnson in his resignation speech, when the FX herd moves, it moves. So you're likely to get some sort of follow through. But the problems about Europe are well telegraphed. And obviously when you have views that are well telegraphed, the FX market or any market can often end up doing the opposite. So it's debatable how long it actually stays below parity.
Well, Simon, we're simultaneously seeing euro weakness, but also broad-based dollar strength. Do we properly understand the ramifications of the strength of the dollar at these levels?
Yeah, I mean, I think that's really the big story. I mean, today, obviously, the excitement is the euro, but really it's a dollar story. So if you look at the last year, against the dollar, the euro is like only the sixth weakest G10 currency. The Scandies, the Norwegian, the Stocky Krona, and the yen have actually weaker than the dollar over the last year. And the dollar, if you really want one indicator that shows you why the dollar is strengthening, it's the real yield curve, not the yield curve. That doesn't really show you a very good relationship, but the real yield curve, which has been very steep, and it's still steep, shows you that the dollar has remained supported. So I think that's really still the big story here over the longer term.
In contrast to what we've seen here in Europe and what's going on with bunds, a point being made to me by our colleague Mark Cudmore earlier on. Simon, thank you very much for joining us. Simon White of the Bloomberg Markets Live team. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition, or maybe today we should call it Parity Watch Edition, because there is one chart none of us can tear our eyes from, and that is euro dollar. The euro ever so close to reaching parity with the U.S. dollar, right now trading at 1.0005. It earlier actually had a 1 figure at the end of that number, so we will continue to monitor this and assess the ramifications. We'll discuss with Antoine Boubet, senior rate strategist at ING, as we talk about what happens if we reach parity, the consequence of it, how long it could stay there, or how further below the dollar the euro could go. That's next. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
This is a market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The euro slips ever closer to parity with the US dollar, touching the lowest level since 2002. Risk aversion is prompting a broad rally in the greenback, while concerns over a recession are weighing on the outlook for the euro area. President Biden flies to the Middle East. The U.S. believes OPEC can pump more oil if the president's lobbying efforts are successful. Still, the IEA says this is the worst energy crisis of all time, and it could get worse. Plus, JP Morgan hedges its risk-on wager. Marko Kolanovic is advising investors to cut holdings in corporate debt. Meanwhile, BlackRock has warned against buying the dip. It sees no quick recovery in sight for stocks or bonds. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Well, if even the bulls are questioning their strategies, then, Matt, we must be mindful. Of course, we're all focused on the FX markets this morning.
Yeah, absolutely. I mean, I think it's fascinating the Kolanovic call, and that bulls are starting to capitulate may mean something here, but I'm definitely wishing that I had a euro chart on the screen behind me. Instead, I'm looking at S&P futures that are down 0.2% right now after the sell-off that we had yesterday. It looks like we're going to fall further at the open, and investors are buying U.S. debt in order to balance that out. Right now, pushing the yield down to 2.9189. So we're holding solidly below the 3% level on treasuries. It's recession fears that are driving that, right? As we get ready to kick off earnings season, they're also driving the sell-off in NYMEX crude. Right now, down $2.78 to 101.31 a barrel. And then Bitcoin is off as well. Right now, 3.5% because it's correlated with risk assets, also because it's priced in dollars in this case, and the strong dollar pushes everything else down. I really do wish I was watching a euro chart. I keep leaning over to try and look at the J screen there in front of me. Kaylee, what do we see in terms of pre-market movers?
Well, I'm watching the chart. 1.0004 is where we trade at the moment, so we will continue to keep an eye on that. But of course, it's Tuesday, so I also will be keeping my eye not just on fiat currencies, but digital currencies as well. With Bloomberg Crypto at 1 p.m. Eastern Time, Matt, you were talking about the declines we are seeing in Bitcoin today. That is feeding through to some of those crypto-related equities in pre-market trading. Marathon Digital down 4.2%. Coinbase, the crypto exchange, down about 3% as well. Another story out there on the company level to watch is Gap. The company announcing yesterday it fired its CEO, Sonia Singhal. Its chairman, Bob Martin, will be stepping into that role on an interim basis, but it also warned on profit given the higher costs and more discounting it has to do. So that stock is down about 6%. And finally, speaking of retail and cost pressures, of course, that is something Amazon has been grappling with, but Amazon is going to try to get a boost over the next several days with Prime Day starting today. So a lot of people, in theory, going to be online shopping. That could be a bit of a sales driver for the company. Nonetheless, that stock is still down about 0.9% before the bell, Anna.
Yeah, retailer theme we'll return to shortly, and the strength of the U.S. consumer or lack of. We are watching the euro, of course. I should tell you that euro 1 month volatility has hit 12.56%. That's the highest since March 2020. We know that things are volatile. We're watching the tick-by-tick chart, and I don't think it's good for anybody's heart rate to be doing so, but that's what we're doing this morning. So it's volatile right now, and looking out over the next month, expectations are that there will be volatility ahead. We are focused on this, of course, because of interest rate differentials, because of concerns around growth in the Eurozone as well. Broadly then, looking at the stocks 600 this morning, we are seeing some negativity, although we're off lows of the session. That's the sort of clutching at straws better news if you're risk on this morning. So half sectors in negative territory, half of the sectors in positive territory now here in Europe. The euro is still moving, as we mentioned. 1.0007 is the latest print we see. And I've also got EDF in there for you, the Électricité de France share price. This is a French, of course, energy business, and the government has said it wants to to nationalize this business. There have been reports that they could spend 8 billion euros in so doing, and that is pushing up the share price this morning. Kaylee.
All right, Anna, well, there are some breaking headlines we want to get to from Treasury Secretary Janet Yellen, who is speaking in Tokyo after a meeting there in Japan. And she says that the U.S. view is that G7 countries have market-set foreign exchange rates. She said that they did not discuss potential intervention to support the yen, which, of course, is right around its weakest level to the U.S. dollar since 1998. And she went on to say that intervention is only justified in rare and exceptional cases. So as we discussed, the Japanese yen at its weakest level in 24 years and a euro at its weakest level in 20 years. Joining us now is Antoine Bouvet, senior rate strategist at ING. Antoine, we're obviously on parity watch for euro dollar. We have seen incredible volatility in FX and in rates as well. What is your take on the consequence of these moves?
Well, it's very important for what it shows about the divergence in economic trajectory between the US and Europe. That's the first point. The second point is because it's also boosting expectations of a more hawkish ECB at next week's meeting. So there's a lot of things in the picture. I think we should keep always in mind the bigger picture, which is we're heading into recession both in the US and Eurozone. It's not a matter of if, it's not a matter of when, it's a matter of how bad it will get. And I think it's going to hit Europe's shore first. We don't know exactly how bad it will be. It depends on energy supply. But this is something that's going to keep weighing on the euro. This is something that is going to keep pushing yields down in Eurozone, more so than in the US and earlier.
Okay, so that's pretty bold. You're pretty short. Well, you've got some conviction, it sounds, around that, Antoine. Good morning. Around the US and the European Union, sort of the Eurozone, going into recession. Let me ask you about what's going on with real yields then, because we were looking earlier on in programming at deeply negative real yields still in Europe versus what's going on in the United States. Things look different. Does that explain for you what's going on here with the FX story? Is that where we should look for the direction of euro dollar?
Yeah, absolutely. So in the US, it's quite interesting to see that ultimately real yields haven't really fallen in that latest rally in bonds. That shows that, first off, the market's not expecting the Fed to turn a lot more dovish in the near term. That also goes to show that inflation expectations are falling quickly, as quickly as nominal yields. In the Eurozone, on the other hand, we're heading to the recession, probably over the winter. Markets are very quickly cutting the ECB hike expectations, rightly so. We're pricing up to 300 basis points of hikes at some point, slightly more. We're below 200. We think that endpoint is about 100, so clearly we are a little more than halfway through that adjustment, but it will continue.
Do we read anything into the fact that we have struggled to get down to 1, to get to parity on euro dollar today? Some of our colleagues pointing to the drop in the pound and saying, look, this is being defended. Somebody is defending this. What do we read into the fact that we are taking some time? It seemed in the Asian session a few times we were going to get through that, and we didn't.
Well, it's an obvious target. I would say there's probably a lot of technical factors behind it, including option strikes that might prevent it from cutting it in the near term. But positioning doesn't seem that heavy. So I think ultimately we'll get there. You know how it works. We bounce off a level for a while because it's defended for whatever reason, and ultimately we break through. And I think this is what's going to happen eventually.
In terms of the ECB, do they come out and do something about this? Do you expect them to start jawboning as soon as we get to parity?
Not necessarily as soon as we get to parity, but clearly it's a concern for the ECB. The question is, what can they do about it? And the answer is not very much. Clearly, this boosts the case for hiking 50 basis points at the July meeting rather than 25 basis points. But that's not really what matters. What matters is the impending recession, whether gas supply is cut off entirely or just partially, and what's happening to interest rates with a 2-year horizon. And these rates keep falling, and they will keep falling, as we just discussed.
Antoine,
so I mean,
as a rate strategist, is this the most you've ever looked at the commodities market? I mean, you have to be well-versed in gas flows, probably for the first time.
Yes, I wish I was, even more knowledgeable about it. I can't say that I am, but yes, it's very important, and not just gas flows, but the general commodity complex. Because what's happening in the near term, we're on recession watch, and that will depend on gas flows. We're also looking at long-term inflation expectations, and these follow the general commodity complex a lot more. So even long-dated interest rate, long-dated bonds become a lot more investable when these inflation swaps fall. And these inflation swaps tend to fall when commodities fall. So that's making the whole bond market that was uninvestable even a few months ago because of a hawkish central bank, all of a sudden it sounds and it seems like a very good recession hedge.
Well, Antoine, as we discuss recession and the ECB further, how many hikes realistically is the ECB going to see through against a backdrop of a deteriorating growth picture?
So 100 basis point worth of hike is the answer. It was very uncomfortable to make that call even a few weeks ago, but the markets moved towards our call, and we're very satisfied with it. Like I said, we're a little bit more than halfway through the move. What will be the trigger for further fall? Clearly, the energy crisis. And yep, that's it really. It's you can even ask yourself if they're going to do that much, to be honest, because the ECB updates the economic forecast in every quarter. So the next time in September it will show recession. The ECB has been very optimistic on this growth forecast. It's no longer sustainable to be that optimistic. So it's hard to see how they can hike aggressively whilst forecasting a recession.
Okay, Antoine, thank you so much. Thanks for joining us. Antoine Bouvet of ING with us this morning. We're still watching the euro, 1.0001, and we continue to push against that parity level, and it continues to be defended, the euro against $1. We will bring you the latest on the FX moves. We'll also ask about the broader trends and what's got us to this point and where we go from here, of course. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Well, markets continuing to defend that $1 level. When it comes to the euro dollar, we're watching it tick by tick on these charts to see where we end at 1.0001 again. But we've seen it do this a few times and then it bounces off. Let us talk to Vasilis Karamanis, who is Bloomberg FX strategist, who can help us understand what's going on here. Vasilis, what do you make of the fact that it seems to be being well defended and we haven't got there yet, and I seem to be asking for the last few hours, are we there yet?
Yeah, hi Anna. Well, this is basically a textbook case of protecting options barriers. Since the euro breached 105 a couple of months back, we've seen options data showing that the parity strike was a very important one for options exposure. So what happens right now is there are some options desks out there that are defending the level. They don't want to see it breached. But at the same time, selling pressure, the euro downside dynamics are so strong that we have this big battle at that level. So what we have right now is options desks versus spot traders trying to get the euro lower. And it's been a very, very busy day for all those desks out there, I presume.
What do you expect if we go below 1? I mean, will we get any kind of statement from the ECB? Will we get more talk about concerted action? Yellen has said, we believe in free markets, but I guess that's the case until we don't, right?
Yeah, exactly. Well, ECB officials are kind of like late to the party. They had some sort of verbal intervention when we traded at around 104, but we haven't seen anything as of comments concerning the euro lately. And it kind of surprises me because the silent period for the next ECB meeting kicks off in a couple of days. So we should expect anything on that side quite soon. But really, at this kind of situation for the euro, with the energy crisis and monetary policy divergence, talk won't cut it. The market wants to see action from the ECB, either from tightening more than it prices in, or seeing that its anti-crisis tool will be strong enough for the market indeed not to test it.
And in the absence of that, Vasilis, how much further below 1 could the euro fall? Where is the support?
I've been looking at options data lately. 98.50 is one level that took some attention last week, but today, as I was crunching the data, I saw many options desks out there trying to buy 95 strikes and 95.50 strikes. So there seems like we'll have a gap lower for the next weeks. I will be closely watching Dutch front-month gas prices against the euro. We were trading this morning around 170 euros per megawatt hour, sorry. If we go up to 200, then we could see euro sliding to 95 cents probably. 250, that means below 95.
Vasilis, thanks very much. Vasilis Karamanis helping us keep track of euro-dollar this morning. Coming up on the program, Amazon kicking off its Prime Day event. We'll speak with Insights Director at Retail Analysis Provider Springboard. That's Diane Whirl. Coming up next, this is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, Amazon is kicking off its two-day Prime Day today, and according to Jefferies, the shopping event may boost the company's third-quarter revenue and help increase Prime adoption in international markets. Let's get more with Bloomberg's Laura Wright. Laura?
Well, the celebration of consumption begins. It's Amazon's 8th annual Prime Day. The stock down around 0.9% ahead of the US bell. Analysts over at JP Morgan think that this Prime Day could bring in a total revenue of $5.5 billion. That's up some 5% year over year. It's interesting. This is the first time the shopping extravaganza has been in July, and that is to capitalize on back-to-school replenishments, as typically parents spend more. Now, Bloomberg Intelligence conducted a survey in July of Prime members, which has some really interesting findings. There is a huge amount of brand loyalty. The average Prime member has subscribed to the platform for 3 or more years, showing fast and free delivery, really attractive. The average spend is projected to be $212. Electronics are the most popular products that customers want to buy. That's followed by home, then fashion. And I find this last point really fascinating. Prime subscribers are split 50-50 on whether they make a predetermined purchase or an impulsive buy. We know that Matt Miller falls entirely in that latter category. But this comes against a backdrop when Amazon Prime subscribers in the United States are stagnating, the States being, of course, its primary market, showing perhaps that $20 increase to annual subscriptions is starting to bite as inflation is at a multi-decade high, discretionary spending is under pressure. But also it's worth keeping an eye on some of the other e-commerce names when they open in the States, such as Wayfair, Shopify, Etsy, Overstock.com. If that doesn't make you want to shop, I don't know what will.
Okay, Laura, thanks very much. Yeah, Kaylee and I are here for the planning. Laura Wright with the latest on what's going on with Amazon. Let's stick with the retail theme. Joining us now on retail is Diane Whirl, Springboard Insights Director. Diane, how significant a day is this for Amazon? And in a year like this, where the US consumer, just like consumers in lots of economies, increasingly wary of rising prices.
Absolutely. I mean, that's the overriding theme at the moment. Inflation is rising. It's as high as it's been since December 1981. People are very, very conscious about household budgets. So the opportunity to shop online with Amazon, with all the efficiencies and the confidence they have in that brand,
in terms of...
Makes it compelling. Makes it very compelling.
Diane, in terms of the impact that inflation's had on retailers, what do you see? I think margin compression is the term that we have heard most ahead of earnings season.
Absolutely. I mean, it's interesting because, inflation is sitting at over 8%. Not all of that can be passed on to the consumer. Some will be. But of course, there's elastic demand in there. And the minute they pass it on, consumers then rail back a bit. So they have to absorb some of that. Attached to that is the lack of supply, and that's really where Amazon comes in. You can't guarantee when you go to a physical store that you're going to be able to get what you want. With Amazon, that's much more guaranteed. Not affordable by any manner of means, but more guaranteed. And you know that it can be delivered in 1 day, 2 days. So all of that really builds into the drive for consumers to be very, very price conscious and then to be drawn toward Amazon.
Well, and to that point, you mentioned how retailers have struggled to get the supply in. As we've seen with the likes of Target, they finally now have the supply. It's just of the wrong items because consumers have shifted what they want to purchase. So they're left with all this excess inventory, and that means that they're going to have to do more discounting. What are you expecting from discounting and price reductions and the actual disinflationary force that could be, Diane?
I mean, it's really interesting around discounting. This discounting, of course, was huge in the last recessionary period, and retailers got themselves into this cycle of discounting, which of course drove margins down enormously and then constrained reinvestment in their own businesses. So when we got to a point where they needed to reinvest, they simply couldn't because they didn't have enough investment capital within the business to do that. The whole thing about inventory is about time and place, particularly for fashion. There is a very, very small window to get the right inventory in store. With other household products, it's less important, but with fashion, it is very, very narrow window. And if you miss that, and particularly with seasonality, you're forced to discount. And of course, that will impact upon their ability to shift other stock. They won't have shelf space, they'll have to store it. So it's going to some degree, have a deflationary impact. But overriding that, they're going to have to replenish with new stock, otherwise they'll have nothing to sell. So that's not going to impact inflation to any great degree. Inflation is still going to continue.
And finally, Diane, have we seen the peak of pricing power already for these retailers? Is their ability to pass on higher input costs now at a cap?
No, I don't believe it is. I think it's only just starting now. I think retailers are discovering that actually they can't now absorb all of the price increase, and they're starting to pass that through to consumers in price rises in store, not necessarily wholly online, and there is a disparity there. And I think that's going to force some consumers online, but retailers are getting consumers used to the fact that inflation is building, and some of that and more of that will be passed on to them.
Okay, it's a different retail universe from the one we've known. Diane, thank you very much. Diane World, Springboard Insights Director. Well, we thought we'd get to parity. I thought we'd get to parity hours ago. We didn't. I thought that the ZEW number might take us through, Matt, and it didn't. It was a really weak reading on expectations for the German economy from finance professionals, and that didn't do it. This level obviously keenly being defended. I like the way that Vasilis put it to us earlier on. He was characterizing this as a battle between the options desks and the spot market, and we see this playing out tick by tick in front of us.
Yeah, we do. I will say, apparently, John Farrow has tweeted we hit parity, right, Kaylee? And if you look at the HCPI function or the GIP function, you may think the same thing. I've been following this screen. It's GIPT. It goes tick by tick. And by this measure, we haven't quite hit it.
Yeah.
Hit it yet.
If you take fewer decimal places,
exactly. I think if you go out only, say, 5 significant digits, you may have hit parity. But if you go out 6 or 7, we're not quite there yet. So the question is, can we ever actually get to parity?
Well, and that raises the point of this is just a nice round number, right, guys? I mean, it already is essentially right at parity. We are just talking about actually reaching the round figure, which raises the question of how consequential this move is really and what it means, because it's not just about euro weakness today, Anna. Basically everything in G10 is weaker against the dollar, barring the Japanese yen. So it's simultaneously a story of broad dollar strength with the dollar, right now the dollar index trading at 108, and that has consequences for commodities. It has consequences for corporate earnings. That's something we also have to dig into.
Yeah, absolutely. And we all know about the interest rate differentials and the recession fears that take us to this point. And I instinctively always think, you know, round numbers, how much does that really matter? But clearly it matters to someone. Someone's been defending this for hours and hours and hours as we've been watching these charts this morning. That's it for early edition. Surveillance is ahead. They'll continue to watch these euro-dollar charts for you. They'll also talk G10 currency with Jordan Rochester from Nomura. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a currency and bond-driven market right now.
The market currently is already pricing in rate cuts next year. That might just be way too soon.
We are heading for some kind of a financial accident.
The Goldilocks outcome is now off the table.
I would be very, very surprised if we went into a new bull market anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Have you seen that euro? Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures negative about 0.75% on the S&P. TK euro dollar, it's basically there at parity.
There's so much more going on, John. What we're going to do here is go beyond parity, folks. Jordan Rochester and Stephen Englander will join us. And flat out, John, this is one of the most historic days in 20 years.
And this is the craziest headline I've probably read so far this summer. Heathrow Airport asking airlines to stop selling summer tickets. TK, there's a headline I'm not sure we expected to read a couple of years ago.
Yeah, afterthoughts on our way over there right now to buy stuff on Carnaby Street. I mean, you know, John, what this comes down to is the gyrations off the pandemic, whether it was the re-lockdown we saw yesterday in China and Macau or Shanghai. But what we need to do is explain to global Wall Street the linkages, the correlations right now are off the chart. It's truly jump condition Tuesday where EM gives way, along with the silliness over euro parity.
Grappling with a supply-constrained economy over in Europe, Bramo, and an energy crisis, let's just call it that people think can get worse.
Well, that was my immediate reaction when I saw this headline. Is it an effort to conserve diesel, to conserve gas and energy, or is this what you said, John, which is basically they don't have the people to staff the place? And how much does this really show the dueling nature of what we're talking about, which is an imposed recession, an imposed downturn, an imposed contraction that we're seeing being speculated about in Germany in order to avoid an energy crisis? This is a new era that's leading to those jump conditions Tom talks about.
TK, this FX stuff is problematic, and I looked at Japan for that. To see a joint statement from Yellen this morning and Japan's finance minister, the Secretary of the Treasury, essentially ruling out FX intervention anytime soon. And Tom, the problem that I think a lot of the currency markets have at the moment is that for a long, long time, these countries have been trying to engineer currency weakness, and all of a sudden it's unwanted. And in Europe, it's unwanted in a massive way.
Well, yeah, what's important here, and this goes back to Folkets Landau and the invasion by Putin, is the assumption of a strong dollar. And I'm going to be very straightforward, as we learned yesterday, John. It is about hoarding of foreigners in cash using U.S. dollars. John, on the energy issue you and Lisa were talking about, let's go to Europe. Rotterdam coal up 530% off a moving average study. And over in Australia, Newcastle, which is not near Perth, Newcastle up 470%. Part of this energy crisis is ESG is dead.
I will not ask you to repeat that accent. And many people agree with you, Tom, on the ESG front. A real reality check over the last 12 months. And Lisa, I think the difficulty you have forecasting the euro right now, if you're forecasting foreign exchange, particularly euro dollar, specifically the euro, you've got to make a commodity call. And if you're making a commodity call in Europe right now, you've got to make a political call. You've got to somehow get into the mind of one man in Russia, in the Kremlin, Lisa, and forecast the decision by him later this winter on gas supply into Europe.
No one can do it, which is why that risk premium is something that is going to stick for a longer period of time, that will be something people charge in terms of a weaker euro just because of such a dramatic lack of certainty. And lack of consistency with respect to who's making these decisions.
Let's whip through this price action for you. We are lower. We're negative 0.7% on the S&P. On the Nasdaq 100, we're down 0.6%. Yields are in again. They were down big time yesterday, again this morning, by 7 or 8 basis points on a 10-year to 291.70. Bramo can't take a rise off it. Euro dollar 100.17. Lisa, negative 0.2%.
Okay, it's basically at parity, and for all intents and purposes this morning, it's been flirting with that level. But this really highlights the nature of the energy crisis, as you were pointing out earlier, which is the reason why I'm so focused on 7 a.m., the OPEC monthly oil report coming out. This comes after Fatih Birol of the IEA said that there is the potential for a global energy crisis that we have not seen before because of some of the constraints around Russia. I want to hear about what people plan to do about it, because frankly, I tried to get my head around some of the caps on Russian oil prices over the past week, and I'm left sort of wanting in terms of details of how this is exactly going to work or what other options there could be on the table. At 12:30 p.m., Richmond Fed President Tom Barkin is speaking at a lunch hosted by the Rotary Club of Charlotte. What is he going to say about how much his decision to raise rates by 75 basis points this month, and then again by another 75 basis points possibly in September, hinges on tomorrow's CPI print? If they get an 8.8%, as Bloomberg certainly currently expects, does that make them go? If they get a weaker than expected print, how much does that push them away from making such a series of rate hikes? And at 1 p.m., Tom, this is just for you because I know that you're going to be trained on this. U.S. is planning to sell $33 billion of 10-year notes. I am watching to see whether the demand that we have seen over the past couple of sessions continues, especially in light of the steepest and most inverted yield curve of the 2-10 spread going back to 2007. John, this is a more persistent yield curve inversion, and is getting a lot of people's attention because it is entirely throughout the curve. Not just 2-10s, not just 7-10s, not just 5-10s, but also the 3-month 10-year curve that a lot of people watch very closely.
Getting messy, isn't it? Do you want to talk about the 20-year? Or should we just move on?
Let's move on.
20 years a mess,
yeah, 20 years a mess.
It's just an absolute mess.
And it's been inverted for a long time.
Lisa, thank you. Thank you very much. This from PepsiCo. Full-year organic revenue plus 10%. That's what they see, Tom. The estimate plus 8%. But get used to this headline, TK. We're going to read it a lot through earnings season. They still see a 2 percentage point FX translation headwind. How many FX translation headwind headlines are we going to be reading through the next few weeks, the next few months?
We're going to see them, and they're going to manage through it. They always do. Everybody makes a big deal about it. I get it. It's accounting reality. Earnings a little less, cash flow a little less, et cetera. But the fact is, the corporations, the multinationals, they'll just manage through it. That's what they do.
Let's manage through things right now with Greg Battle, the U.S. head of equity and derivative strategy at BNP Paribas. Greg, let's start here. Just how bad are things going to get in Europe?
Well, I think that the recent price action we're seeing in the FX markets, the inversions that we see in the yield curves, it's really pointing to more recessionary price action. I think the outlook for what happens with gas supply, whether we see gas rationing, is going to be a huge swing factor as to whether or not we do have a sharp contraction in Europe.
Greg, in the equity market, the question a lot of people have is the value of cash here. There's a real worry. VIX 2709, maybe the VIX almost feels 30 again now. What's the value of going to cash versus finding the right spot in equities?
Well, I think the thing that we have to try and do is to trade off this volatility that we see persistently in the equity market versus the cost of carrying an allocation to cash, which is effectively the price of inflation. So we're going to have this CPI print later this week, which could well be the peak in the cycle, but a very high number. So there's a large opportunity cost of going into cash. But so far this year, it has been something that has paid off in these turbulent markets.
And meanwhile, the safety trades in equities are being turned on their heads somewhat. We've seen oil stocks, for example, come out a bit as we see oil prices go down on the fears of a lack of demand. How much do you think this is a head fake, and how much is this a real shift in terms of the leadership that we've seen so far from commodities?
Yeah, thank you, Lisa. I think it's a great question. We've seen some real changes in leadership over the last weeks in equities. So at the start of this year, we've really seen the tech names underperform, and it's been a multiple compression story. We think as we move through the earnings season and through the next couple of quarters, the market's going to be far less focused on what rates are doing and how that's compressing valuations. Yeah. And it's more going to be an earnings story. So something like the energy sector, I do think is uniquely interesting. You know, you have to be cautious of the potential for demand destruction weighing on the oil price. But we have had years of low capex investments from some of these oil names. We have very low single-digit P multiple valuations for these oil stocks. So we think there is some asymmetry there. And if we can see crude stay within the kind of range that it's been in recently, then we think there's actually potential to still see upgrades to earnings forecasts for the oil names. And against a backdrop where we're seeing downgrades pretty much everywhere else in the market, I think that makes it a slightly unique sector at this point in the cycle.
Greg, very quickly here, Mohammed El-Arian is out with a beautiful phrase which captures the jump conditions of the moment, plural, and that is little fires everywhere. That perfectly describes what's on my Bloomberg screen this morning. How do you adapt in equities when you see the little fires in FX and in CDS and in debt?
Well, I think undoubtedly we have to take these warning signals cumulatively. And I think indeed equity markets have digested this. We've described the price action that we've seen this year already as recessionary. We've had an absolutely massive valuation compression this year, and we've entered an equity bear market at a time when things like the labor market data is still very strong. The PMIs, certainly in the US, haven't really rolled over. So I think it's fair to say that the US equity market is part of that story. It's already signaling that things are going to get worse. The question is how much worse and how quickly.
Greg, you flying back to London anytime soon?
I am, and the conversation you were having earlier is making me a little nervous about my connection.
Me too. Greg Battle of BNP Paribas. Greg, great to catch up, sir. If you're just tuning in on TV and radio, here's the headline. London's Heathrow said it would ask airlines to stop selling tickets for summer travel. There's going to be a cap, Tom, a cap on daily passengers of 100,000 through September 11th, according to a statement delivered just moments ago. 100,000. What we understand from the latest travel forecast, the airport would have had to handle as many as 104,000 passengers a day over the summer. And Tom, this just comes down to staffing. I'm just going to read some of these quotes. The new recruits were not up to full speed. Certain functions, including ground handlers for baggage, were, quote, significantly under-resourced. There is a labour problem. And we know, Tom, and we know we are supply constrained in a material way, particularly in this industry.
How do you solve a labour problem, John? It's real simple. Pay them more. They will come out of the woodwork.
What if they need more training, Tom? What if this is just about a duration issue?
How long does it take to train a baggage guy?
It can take weeks and it can take months for certain elements of airport staff because of security issues as well, Tom. So to ramp up capacity, to ramp up staffing in certain places, certain industries, it's really, really difficult.
So what do we do? Go through Copenhagen? Do we go through Madrid? I mean, you tell me.
Well, 100,000, Lisa, how much of a problem are we going to see relative to what they forecast?
Well, this is fascinating for people who are traveling through Heathrow, as Tom indicates, but it also is a bigger issue, right? Which is that basically we cannot increase supplies, we cannot increase capacity simply because of the staffing dissonance, and it is difficult to solve. We've heard it from everybody. This is not just a simple pay them more, bring in more people, because the turnover has been dramatic.
I think for a lot of people, they've already lined up outside certain terminals at Heathrow, trying to get their tickets and get through security. I think they're probably sitting here thinking, about time. I mean, seriously, where was this call weeks ago, months ago, when these tickets were sold? Futures negative 0.6% on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The euro is moving even closer to parity with the US dollar. It hit a 2-decade low earlier today. Risk aversion has led to a broad rally in the greenback. Meanwhile, concern over a recession is weighing on the outlook for the euro area. And the price of oil is falling again today. A COVID resurgence in China is adding to concerns about a global economic slowdown. Meanwhile, the White House says OPEC has room to raise production if President Biden's upcoming trip to the Middle East yields any agreements. One of the president's stops will be in Saudi Arabia. The Conservative Party in the UK wants to narrow a wide field of contenders to be Britain's next Prime Minister. It will require candidates to have the initial support of 20 Tory members of Parliament. Nominations will open and close today, with the first ballot to be held on Wednesday. The party's new leader, and therefore the UK's next Prime Minister, will be announced September the 5th. And London Heathrow's airport is taking another step to put an end to the summer travel chaos. It's asked airlines to quit selling tickets for this summer. Heathrow has imposed a capacity cap of 100,000 daily departing passengers until September the 11th. Staff shortages have led to long security lines and misplaced luggage. And it is the first time human beings have seen a distant galaxy cluster as it appeared more than 4 billion years ago in such vivid detail. President Biden unveiled one of the first full-color images from the James Webb Space Telescope. The telescope was sent into orbit roughly 1 million miles from Earth late last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Season is here.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
quite strong in America right now. Inflation is our challenge. The Fed is appropriately taking action. The administration is doing all that we can do. And I think, and a strong dollar is as it is, which I am not worried about.
I'm sure they're not worried about it at all right now. Gina Raimondo, the U.S. Commerce Secretary, that's part of the operation, isn't it, Tom? Get inflation down, a stronger dollar.
Yeah.
That's going to help.
It's going to help to a point, and then it goes the other way. It's called ambiguity. George Saravelis of Deutsche Bank Publishing moments ago, I believe, with us yesterday, John, and I love, he's on script with you, me, and Lisa. Euro parity, it's not significant, but what is significant is a lack of liquidity out there due to this global slowdown we're looking at. And John, excuse me, again, you see that over in the yield space.
We've had a 12% move on euro dollar this year. It's already been a massive move. We're just going to run through the market action for you this morning. If you're just tuning in, we're down about 0.6% on the S&P. On the Nasdaq 100, we are down 0.4%. What we see in the bond market going into CPI tomorrow is a real bid into treasuries. Yields lower again by 7 basis points, Tom, on a 10-year 292.07. And those of you following the chart, euro dollar 100.14. We're negative 0.25%, Tom.
Let us digress to what we cannot imagine. Imagine standing there last night with 1 grain of sand outside the beach house up on Cape Cod, let's say, and you put the grain of sand up in the sky, and that is the image of what the James Webb Telescope has done. I know it's a science diversion. I know no one cares, but the light from that image, and on radio it is that spectacular image of galaxies, is 13 billion years old. Joe Matthew knows what it's like to look at the images of a Washington where light travels at the speed of molasses, and he joins us.
I thought you were going to say looking at people who are 13 billion years old.
It was quite a wind-up because, geez, do we wish Washington ran like James Webb and the good people at NASA?
Well, let's remember, sometimes the government does cool stuff. This is a NASA product here. That is a government agency that generated something as incredible, and not anyone seemed to notice it yesterday.
How shut down is your city, Joe? It's 92 degrees. We're looking at NASA pictures out into the middle of nowhere. Let's look into the interior of Washington. What's the level of shutdown in Washington?
Well, lawmakers are coming back. House lawmakers today, Senate back yesterday. We've got the January 6th committee hearing today. And yeah, it's going to be about 96 degrees with extreme weather thunderstorms predicted this afternoon. Lots of symbolism hanging over this White House as the president gets ready to head overseas. Shut down, not so much. It will really feel that way next month, though, which reminds us that lawmakers have, gosh, only about 3 weeks to get a lot of things done before they head home. I won't call it their recess, but to their home district work period next month.
That's a wonderful euphemism. I think that I'm going to head home to my home district work unit over in the Adirondacks. I am wondering, Joe, if we're talking about the main issues, one of them is gas prices, and we have seen them come off just a little bit, but there is a big talking point about capping the price that Russia gets for oil and gas. Does any of this make sense to you when you look at the nuts and bolts of how this plan has to work and getting everybody on board globally?
Boy, be careful. Be careful in ever asking me what makes sense to me, because sometimes we can simply report the facts. It's hard to rationalize what's going on. And that cap has yet to be established, but it will certainly be in the front of President Biden's mind as he heads for Saudi Arabia this week in the hopes of unlocking some extra production. The question, though, is, number one, is there spare capacity, as Saudi Arabia and the UAE suggest, about 3 million barrels a day? And even if we can tap that, what do we do with it when it comes here? The refining bottleneck is a major issue. 95% capacity is where we're running right now. So even if the president scored a big deal, announced a big gusher of oil that was coming, we may not be able to do a lot with it, enough at least to impact prices at the pump.
Is this cabinet basically resigned to getting a beating in the midterm elections coming up because it is so difficult to get some of these base factors down?
I'm not sure. It depends who you ask. They each have their own personalities. You know, Marty Walsh is going to have a different answer than Pete Buttigieg when it comes to that. But now that we're coming up on November, now that we're getting into the second half of the first term, if you will, it is likely that we'll start seeing the revolving door swing a bit more. We did see the communications director, Kate Bedingfield, announce her resignation most recently. So it's difficult to tell. The fact of the matter is, though, if they haven't left yet, they're on board for the midterms, and they're going to be fanning out across the country to try to make the case for this president on the trail.
Joe Matthew, what does Joe Manchin want to get accomplished here? I mean, I get the battles that are going on in that, but I can't get a straight answer on what his goal is to get to the
I don't think Chuck Schumer can either. I think that remains a question. They want to have something to show for this session. And you remember Joe Manchin, laid down the $1.5 trillion and so forth with Build Back Better. It looks like there's going to be a Build Back Better light, if I can keep calling it that. They are moving ahead with a reconciliation bill, but it's getting complicated, Tom, and there's one thing I want you to look out for, and that is the expiration of enhanced subsidies for Obamacare, the Affordable Care Act. They expire at the end of this year, and that reconciliation plan could be the only avenue that Democrats have to revive those or extend those subsidies. Otherwise, we're going to be talking at the end of the year about another mess with millions of people potentially losing their health insurance.
Hey, Joe, we'll be talking in the next hour. Looking forward to it. Joe Matthew there, down in Washington, D.C. Just yesterday, we got a full breakdown of Bank of America's credit card spending data, debit card spending data.
Tell me about that.
Really interesting stuff when you look at the gasoline spending. Up another 4% in June, up 20% over the last 5 months or so. And this is starting to take a toll on other categories of consumer spending, including services, according to them. Spending on travel and restaurants fell for the first time since January. Now, you remember what happened in January? It was the Omicron surge, the peak of that, Tom. So month over month, the first decline since January for spending on travel and restaurants. Interesting stuff from B of A yesterday.
And not to link it too tightly, but Gap Stores shows the door to their CEO with tepid sales.
I saw the same thing, Tom.
You really wonder, with an obvious retail fashion and all that, but just in general, wonder how they're going to do. What am I going to focus on? I've got to focus on the well-done machine of Home Depot. It'll be fascinating to see how Home Depot performs.
You've taken us to housing, Tom. Redfin put out a report yesterday as well. Lisa, I'm sure you saw this one. 60,000 home purchase agreements fell through in June. Almost 15% of homes that went under contract that month. That's the highest percentage since March and April 2020. Now, you can imagine why people were spooked in March and April 2020 and pulled out of closing on houses, but people are spooked. People are spooked and they're getting crimped. Their spending's crimped by what's happening with gas prices too.
They're getting spooked when it comes to the transaction volume of housing. You are seeing in certain regions the prices come down just a touch, but not dramatically. The worry is it is not going to bring rents down quickly enough, that some of these fissures are not going to bleed into lower CPI, lower basic inflation for the average consumer quickly enough to curtail some sort of ongoing tightening and disruption.
Lisa, you've been on top of that story. Looking forward to the coverage of that tomorrow. CPI in America tomorrow, then on to bank earnings in America.
Is Lisa with us tomorrow?
Lisa will be with us over the next couple of days, and then Bramo is on a jet plane.
Oh, that changed.
Flying far, far away.
You know.
You're going through Heathrow this weekend.
Yeah, I'm going to travel through Heathrow. Although I think, that was just cancelled.
Futures down 0.5% on the S&P from New York. Good morning to you. This is Bloomberg Surveillance.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
New York City this morning. Good morning to you. Equities lower by 0.5% on the S&P, on the Nasdaq 100 down by 0.4%. An update from Marko Kolanovic over at JP Morgan. He's gone from max bullish to about 95% max bullish.
Abrupt change.
I'm going to build on that a little bit later. I'll build on that in just a moment. In the bond market, we look like this on 2s, 10s and 30s going into CPI tomorrow. The headline estimate about 8.8% and maybe a little bit higher. We'll build on that with Ian Shepherdson at Pantheon, with yields coming in ahead of CPI. I want to finish on this, though. I know a lot of you are very focused on what's happening with euro dollar. Let's talk about the problems behind the single currency, and it's all about energy. It's all about gas and what happens to energy supplies into the continent through winter, 6, 7, 8, 9, 10, 11, 12 months away. But Tom, that takes me to growth. And what Goldman did with copper, I think, is worthy of a little bit more attention. Their price target comes down from about 86.50 down to 6,700. Right now, 7,472 on the LME, and we're softer by about 1.5%. Tom, if you're out there looking for a big global growth resurgence in the second half, Goldman's not on board when it comes to copper.
It's drifting away. And when you look, John, at the summation of the coal charts, the copper charts and such, the WTO forecast of 4 or 5 months ago of 2.8% global, we laughed. Guess what?
Yeah.
We're there.
Well, Tom, I've talked about the problems forecast in the euro. You've got to make a forecast on the commodity market. You have to make a forecast on gas. And with that, you've got to make a forecast on what Putin may or may not do. When it comes to copper, you've got to make a call on what happens with lockdowns in China. And that's just as hard, isn't it? Because that comes down to President Xi, how we define success, whether we are reopening or locking down. And the latest evidence out of Shanghai at the moment points towards perhaps more restrictions.
Yeah, we're seeing the restrictions, hospitalizations by one study up 18%, even as deaths stay flat. But John, you know, I do take your point on that. Are you done? Do you have any more FX
I am
for
done.
us?
The only thing, the bottom line, whether it's copper, whether it's the euro, your forecasts are based on the whims of two dictators. You've got to work out what they're going to do.
Yeah, well, we'll have to see. Futures negative 21, the VIX 26.94 out of stick. Right now, quickly on the Heathrow story, a gentleman who is quite good at aviation. He watches Big Jet TV all the time. 777 incoming. Guy Johnson joins us at Heathrow. Guy, what is the distinction of the chaos at Heathrow?
It is getting worse. And while there are different problems in different parts of the world, for instance, United Airlines blames the air traffic control system in the United States as being its problem. Here in Heathrow, we're dealing with a situation where they simply can't train enough staff quickly enough. There is a note that has been published this morning by John Holland Kane. He is the CEO of Heathrow. It starts off, "Dear passengers," and it goes on, Tom, to talk about the arithmetic of what is happening here. They're trying to bring people in. It's a slow process. They're hiring as quickly as they can. Then they're struggling to train the staff as quickly as they can, and they're simply not keeping up with the demand that exists at the moment. So the arithmetic, Tom, goes something like this. Heathrow is now saying that it can deliver 100,000 passengers a day. It can't do any more, and it is now going to cap it. What it is saying is that by its current forecasts, looking at the current forecasts, airlines have booked around 104,000 seats per day in and out of Heathrow. And what they're saying is they can't do that. What they're saying is that there's an excess of 4,000 there. 1,500 of those seats have already been booked. 3,500 haven't. So what Heathrow is saying is, you can't do any more, guys. You're done. We're at the 100,000 limit. We're slightly over it, as a result of which you cannot sell any more seats this summer coming in and out of our airport. This is a huge problem for the airlines. They are obviously trying to rebuild their balance sheets, Tom, as a result of what happened during the pandemic. But capacity constraints, labour market constraints are now a massive factor, and they cannot do it. 100,000 passengers, that's it, we're done.
And Guy, this does not necessarily bode well for the inflationary backdrop, because people will actually be willing, it seems, based on the demand, to pay more for those tickets, and airlines will demand more in order to compensate workers. How much is this an airline-specific story, an airport-specific story, and a broader one in the entire workforce in the United Kingdom?
It's a much broader one, Lisa. Last night, the train drivers voted to go on strike. You've seen other train staff going on strike. You've got barristers on strike. It is across the economy right now. The service sector is definitely feeling it, and feeling it in a really big way. We are short of staff. People have left the labour force.